Hello? Are we live? I think we're live. What up, what up? Another beautiful stream. We're a little late as always, but it's whatever. Much love. Hope you guys are having a good day so far. Hope you're ready for young Jerome. Young Jerome. Dude, AMD is insane today. I bet they were insane. I bet there were some crazy options. I guess not that crazy. Like, still like 500 percenters, but I was honestly expecting more. Because usually premiums get whacked out after earnings. And like the stock drops coming in after the earnings, like all the premiums will go nuts. And you can usually pick up some super cheap, like if you look at I mean, I'm sure it's the same on AMD, but if you look at these Apple Januaries, we go to the at the moneys, the 150s. Yeah. Oh no, it wasn't these ones I was looking at. It was the 2023s, the 150s. You could have got these for like $1,600 earlier, and now they're almost $1,900 just in one day. And this is a contract that doesn't expire for another like year and a half or something like that. It's kind of crazy. I'm probably talking to myself. Is there even anyone even here? No one probably even got that. Oh, there's two people here. What's up? Hopefully you guys got that game. What up? How's your guys' day going? You ready for young Jerome? Young Jerome Powell? I bet there were a lot of decent pickups in the morning. We should look at some. Jon Snow, what up, bro? Haven't seen that name in here before. Hope you're having a good day, bro. I don't think Powell starts for another like hour and a half, though. You get the interest rate decision in like an hour, and then an hour and a half, I think. Oh, no, never mind. Press conference is in 2 hours, and then the interest rate decision is in an hour and a half. Let's look at some other stuff. Microsoft. Let's just look at the 2023s. New to options, been doing well. Good, bro. Make sure you're buying shares, too, of good companies and investing in yourself. Don't just trade, bro. Take all the opportunity of the market. Do both. Trade and invest. Let's see. Yeah, see, the Microsofts weren't down as much. Like, the Apples were a steal. Let's check AMD's 2023s. I bet those were nuts. 100. Oh no, see, these are the same price they were yesterday, but still 1,500 into 1,750 for a contract that has a year and a half of time. That's pretty dope. Trading on small account, bigger stuff in ETFs and physicals. Nice, bro. That's what I'm talking about. If you have any questions about options or anything, let me know. I've also got a bunch of old videos about options that I made forever. Selling puts. Selling puts is instead of just having the shares. Well, what? Oh, never mind. You said, have you ever sold a call either? Like, have you ever sold an option? Because, like, the way you sell options is if you want to sell a call, you have to have 100 shares because, just go to the basics of what an option is. Buying a call, you're buying a contract that's stating you have the right to buy 100 shares of that stock at whatever your strike price is. And then if you're selling a call, that's why you got to have 100 shares because you're writing a contract to sell 100 shares to someone at that strike price. And then it's the exact opposite with a put. So when you're buying a put, you're saying that you're buying a contract stating that you can sell your 100 shares at whatever strike price if it ends in the money. So when you're selling a put, that's stating you're going to buy you're buying a contract or writing one, my bad. You're selling a contract to that states that you have the right to buy 100 shares of that stock at that strike price if it ends in the money. So say we did one on Apple here right now. Say we did like a weekly, I don't know. I wouldn't really recommend weeklies. Like, I would shop for options when it comes to selling puts and try to find a decent priced put that's pretty far out of the money. You have a lot better chance of winning. Like, honestly, Tesla is probably one of the best examples. You just have to have a lot of margin, so I don't know if it's really worth it. But anyway, so when you're selling a put, like if we sold a put on Apple right here, say we sold this 142 put right here, we would get this $113 into our account as credit. And then say Apple drops down to like $140 by the expiration date, August 6th. That means if on October 6th, by the end of the day when the contract expires, if Apple's trading anywhere below 142, we're going to have to buy those 100 shares. So even if it was trading all the way down at 135 and we had that put sell, we would have to buy the 100 shares at 142. So that's your downside. So it's usually best to sell puts on like companies you wouldn't mind owning shares in, just in case that happens. But on the flip side, if you're selling the put and say come to expiration, Apple's trading at like 145, 146 or something. This put you sold for $113 would maybe be worth like $20 or something. So you would just be able to buy it back and you would make like $80 profit or $90, whatever. So you can close out the contract at any time, or you can, let it ride to the expiration date and get your full amount of money if you don't feel like it's going to go below your strike price. So that's why I said it's usually better to try to find a stock that's has a lot of premium at further out contracts. Like, it's because you don't really want to trade an at the money put sell, because I don't know, you can do it, you'll get a lot of premium, but you better just be comfortable with buying 100 shares of the stock, because I don't know, it just depends what happens. The best thing about selling contracts versus buying them is you can truly like ride the contract out and have a chance of winning on the contract all the way to the expiration date. Whereas if you're buying a contract, like 2-3 days before the expiration date, if your contracts, or if the stock's not even close to your contract, it's already pretty much worthless. So that's kind of the benefit of selling options over buying them. But I don't know. Yeah, I don't know. You're kind of, in my opinion, you're kind of just getting a small amount of money by risking a lot, but you're not really risking anything because, worst case scenario, you have to buy your 100 shares on the put, and then if you had the 100 shares and you sold a call, you just have to sell your 100 shares. So it's not like anything crazy, but still, you're not really taking the power of options selling it. But I mean, if you want more consistent returns and you're able to make a good selling strategy, I mean, it would work. It's just going to tie up a lot of capital, which sucks. So, yeah, hopefully that helped. But I mean, if you have a lot of cash on the sidelines anyway that you're not doing anything with, like, you could just sell the puts or whatever. I don't know. Not a recommendation, but you know what they are now, so you can come up with your own plays or whatever. But yeah, also, like, you could take advantage of put sells during like volatility. Like today, I bet some of these contracts on Apple, it was going down quite a bit the first like 5-10 minutes in the morning. I bet some of these contracts were worth quite a bit. Like, see, this 141 contract this morning was worth $90. You could have sold a put on that, and then if you knew Apple was going to bounce, or you could have just bought the option, whatever. Like, you would have made more if you bought the option, obviously, but if you wanted a safer play, I guess, you could have sold a put, made a little bit. In that situation, probably would have been better to just buy the option, but I don't know. There's just so many different strategies you can do with options. It's crazy. I just try to keep it simple. Usually more share buying than options. Will my call go red? I mean, it depends what you paid for it and how much time premium it had when you bought it, or just premium in general. But, I mean, just a simple way to look at it, every dollar you're in the money is $100 on the option. So if you spent like, $150 on the option and you're like $3 or $4 in the money, you should expect to be up at least $100 by the expiration, but you do have to take time premium into consideration, of course. So if it hits my price sooner, I should just sell while green. It's up to you, really. If you think you can get more out of the option, if you think the stock can continue to go up, you can hold it. But usually it's better to take profits, especially if you have like 100, 200% or something. Like, that's a decent gain. And you can also just like sell the option behind it, create a debit spread, and then you still have like, you got money in your account, and then you still have the play on the table because you have that debit spread. And if it continues to go higher, you can if both your contracts expire in the money, you get the max gain on that debit spread, and you already got profit. So you could do that. Or you could no, that's probably the best thing to do. Either take profits or turn it into a debit spread and continue to ride it if you think it can go up more. There's 5 people in here. What's up? How you guys doing? Make sure you hit that like button. Still got like 2 hours before Powell, so we're just going to be chilling, watching this chop fest. Where'd all the OGs at? Nobody. Shout out everyone here. What are we looking at? You guys looking at any specific stocks or any trades you've done today? Sold an AMAT. Nice. Nice. I haven't looked at AMAT stock in so long. Dun, dun. They killing it. Killing it. The hell? Tilray skyrocketed. Jeez. Was there like weed news or something? Oh no, Tilray had earnings. I forgot. Mm, mm, mm. Robinhood discusses plans to be market maker. I don't know about all that. I don't know. Mm-hmm. Where Google at? Google always destroying. Google's insane, bro. It's out there. Google's always coming in and just like, what's up? How you doing? Do you remember me? I only go up, I swear. Slow day. The morning was pretty alright. So Oh shit, sorry. I wasn't even looking at the chat. Nah, Pal hasn't been on yet. He's not on for another like hour and a half or like hour and 40 minutes. The interest rate decisions in an hour or an hour and 10 minutes. And then yeah, then he'll be live hour and 40. What up, Tiger Wood? Tiger Wood. That's funny. Haven't seen that name in here before. Hope you're having a blessed day. Betrayed my guy. Much love, bro. Hope you're doing good. I wish I could see your avatar. Is that frickin' Master Splinter from Ninja Turtles? Oh no, it's a tiger. A tiger. Never mind. I couldn't see it. Like the avatar's so small on my chat screen. I was like, is that Master Splinter, bro? Hippo. What's up, Hippo? Make sure you guys hit that like button. Much love. Appreciate you being here. Hope you're ready for the Powell. Mo. What's up, Mo? Never seen that name in here before. Hope you're doing good, bro. Not much. What about me? I'm just chilling. Chilling, bro. Getting ready for this Powell. Coming to hang out with my people. Come to, you know, See if we get more people. You never know. Pal days, anything's possible. Mega troll. He kind of is. he's like he's like how he makes people feel he is a troll, but like I don't think he actually tries to be a troll. He's just doing his job, you know? That's the funny part. I don't know though. I don't think this Fed meeting will have anything we haven't seen yet. Maybe they'll start talking about tapering, but I really doubt it. I don't think you'll see it. Maybe you'll see that in the next one. Maybe 2 meetings from now. But I don't think it's going to be anything different from normal this time. But we shall see. What results do you think would happen if the rates are high? Well, they're not going to change the rates for another like year and a half. So maybe a year. But so you don't really have to worry about that. But you would probably get a reaction out of the market in the short term. And then, I mean, it would continue to, the market would continue its bull run because having high interest or just flipping the interest rates, it doesn't take an immediate effect right when they change it. So it'll probably take like a year or two before you see like the actual full effect and slowdown of them increasing higher rates. But I mean, that's just me going off of what has happened historically from what I've read. So that's not 100% accurate. Like anything could happen, really. Like the whole market could have a frickin' tantrum that they're taking away all their money and shit, and it could go down. And I don't know. There's a lot of possibilities, but I wouldn't say it would be the end. Yeah, the dip should probably be bought. Not a recommendation, but the dip is usually always wanting to be bought. But yeah, I wouldn't even expect higher rates for another year. You might even start to see a reaction out of the market when they start talking about it, realistically. When they start talking about increasing interest rates and decreasing the buying of the mortgage backs and all that shit, like you may see a reaction. But until then, I wouldn't even stress on anything. It'll just give you an opportunity to hopefully buy all the companies you want right now at a cheaper price. Elvis, smash that like button. Make sure to drink that water. I don't think I've even drank water today. So, God bless you. I need to go grab one. Look at this guy reminding me to get the water. Hey, much love, Tiger Wood. Hope you have a good day at work. Feel free to come back in for the Powell speech. Second, everyone don't talk bad about Powell and his fake news. Damn right. I love Powell. Me and Pal are best friends. We hang out. Like, we ride our bikes together and stuff. Just kidding. I don't think I'd want. Well, that's a lie. I would definitely want to hang out with Pal. I bet he's a fun guy. But I probably wouldn't want to hang out with him. Second, there's a whisper of inflation. The market will freak out. I mean, the last report was pretty insane, and the market's chilling, so I don't know. Chug a water. I'm not going to chug it, but I'm definitely going to be drinking some. No, I think I drank a water today. I don't know. I forget sometimes. I'm pretty sure I drank one today, though. I don't even type that fast. Look, should I take a typing word test? See how fast I actually type? I don't know if I could do one right now. Let's see. Typing word test. Free check your typing in 60 seconds. Do you guys want to watch me do this? Let's see how fast I type. This is going to be hard. Oh, no. All right. You ready? I guess 60 seconds to see how fast I can type, and we can even still watch the market. This is going to be difficult. I haven't done this in a while. All right. You ready? I'm ready. All right. Oh, this is actually going to be really hard. Oh. fuckers. Dude. Bruh. Bro. This is so hard. $55 words per minute, and I messed up a few times and backspaced it. That's pretty decent, I guess. For not doing a typing test in a long time, 55's alright, I guess. I used to be able to do 100 when I used to play RuneScape all the time. Because before they had like the Grand Exchange and shit, you'd be typing so much. Trying to barter and shit. And then, I don't know. I just don't type anymore. I think like the key to being able to type fast though is being able to type without looking at your fingers. If you can do that, it's usually because then if I don't know. I've played too much. Too many computer games. Like I said, I used to be able to type way faster. Me and this me and this one kid back in the day, like I would say like middle school or something, we would just have challenges to see how fast we could type, and we'd get up to like 120 words a minute and shit. On some sentences, we could do like 200 because, you know, like a 5-sentence thing is pretty quick to type. Not satisfied until 80. 80 would be so hard. I'll try one more. I don't think I can get faster than 55 though. Unless the only way I could do that is if I didn't mess up, because backspacing takes so much time. All right, here we go. We'll do another one. No. That's a hard word. Damn it. No. Bro, I got 65. I was doing so good until I messed up on that one word, and then it killed my vibe. I was going for 80. All right, last try. I think I can do 80. I just got to not mess up. God damn it. I just mess up immediately. Oh. Bro, I need good. I gotta get it. All right, here we go. Right here. Bro. No. Why so many hard words? The short words are the hardest ones. Because you got to press enter. And it's so annoying. It doesn't just let you go to the next word. Gosh. Bro. Damn it. I got 69 words a minute. That's good enough. I'm done with this. It pisses me off that I mess up so much. Like I was in the fucking zone, then I just kept messing up. And I still got 69 words a minute. Jeez. That shit's intense. Got me wondering how fast I can type. I was in the zone there for a second. I'm pissed. I felt like I could have got 80 that time. It's freaking Pal Day and we're over here typing. I bet people are coming in here and like, what the hell? What is this guy doing? He's just typing. He's not even trading. Why isn't he trading? I want to see some trades. Ah. I just want to see a trade. Duolingo? Duolingo IPO'd today? Of course. How is this thing at $144? And why aren't we streaming it? What the hell? How is this that much? Duolingo is not that good. Bro, I need to look at this. I didn't even know this was IPOing. $5.1 million shares at a price of 102. That's such a small float. Bruh. Duolingo ain't even profitable. What the fuck? This thing IPO'd at 140? Are you kidding me? This is garbage. It's not even good. What the hell? Duo, man. Disappointing. It's only traded 1,000,007 volume. Psh, that's disgusting. Poor Duo. Duo. I just want to watch this get clapped. I don't know why. It's just funny. Spy's about to hit lows of the day. I mean, we can maybe trade it. CPE. Nice. Well, this is the CPE. Colin Pete. 51. That's what I did the first time, so that's pretty good. Careful with that. You got about 40 minutes till the interest rate decision. It's quite some time. Market's so slow. Bank of America popping. Damn. For 7 on profit, then turned around and bought shares. Ah, smart man. Except, I don't know. I just don't like the way CPU looks. Wouldn't be unless you're just trying to squeeze a little more profit out. I don't feel like that would be a long term for me. I don't know. I also don't know what that is, so that doesn't help either. Be talking about whether or not he's going to be shutting down Washington again. I should be back for Powell. All right, for sure, Betrayed. Much love, bro. Appreciate you. I gotcha. I gotcha. Countdown to Powell. Your time has come. Countdown to Powell. Wait, he's going to be on? Oh wait, maybe the interest rate decision comes out in 4 minutes. I thought it was an hour or 30 minutes from now. I'm confused. The stream says it starts in 30 minutes, so I'm confused. I thought they did the interest rate decision and then 30 minutes later. Uh, what is this, bro? I don't know. They confusing me. Get my shit together. What do you mean? My shit is together. It's the calendar's fault, not mine. Calendar trying to lie to me. Countdown to Powell. Just make you stare at Powell's face. He can look into your soul. I'm just going to leave him up like that. Oh, shit. That's funny. I think we have some earnings after hours, too. A lot of earnings, actually. What is this? Yeah, we got Facebook, Ford, Qualcomm, Yum China, ServiceNow, Spirit Airlines, and probably a lot more. And then before the open, MasterCard, Overstock, Altria, AstraZeneca, Merck, Yum. I'm sure there's more than that. Those are just the main ones. Sweet nothings to him. I will. Me and Pal go way back, bro. Back in the day. Your pal has come. Mr. Powell. It's probably creepy. Nobody talking and Powell's face just right there. Just like, what the fuck? Where are we? This isn't what I logged into. Are you working right now, Elvis? You on that grind? Dang my oil stocks. Working. Nice. Nice. Monday to Friday, 65 hours. Damn. Grinding, boy. Killing the game out there. Killing the game. What's the price of crypto today? Whoops. 39. Ripple's doing pretty good. 20 more minutes till JP. Big Powell. Ugh. The Big Powell. Home Depot's coming down a decent amount. The Home Depot. What is this? Flora Growth? Jeez. That thing's insane. It's up over 100% in like 3 days. Das crazy. Pally, pally, pow. Pow, pow, pow. Pow, pow, pow. And there's 6 people in here right now. Much love. Hope you're having a blessed day. Make sure you hit that like button. Pal, I don't know why it says 15 minutes on the timer. I'm pretty sure it's like 45 minutes. But I don't know anymore. So we'll see. Moo J. What's up, Moo J? How you doing today, bro? I don't think I've ever seen that name in here. So welcome. Hope you're feeling blessed. Chillin'. Chillin', chillin'. Same. Just waiting on young Jerome here. Patiently for Tesla to rocket on my options. Just be careful trading options on there, bro. You can always just trade shares. Waiting forever on Powell. What's up, Sean? How you doing, bro? Glad to see you back. Hope you're having a good day. Down 150. Well, I don't know. Just next time, don't gamble as much. Do like $50 or something. Maybe 100 max. I don't know. Maybe not on an earnings play either. Earnings is a little sus. I don't like playing earnings. The possibilities to make a lot with a little is, there, but I don't know. Earnings is whack, honestly. Starts in 11 minutes. I have no clue. Yeah, I'm pretty sure it's in 40 minutes. I don't know why this one says in 10 minutes. Oh, I know. What's up, Jonah? We'll see. We'll see what J Pow Pow has to offer us on this fine day. SPY had a decent bounce off the lows of the day yet again. It's beautiful. I didn't think it was just going to rocket up like that. I was waiting for like a little bit longer. But I guess that should have been in there like swimwear. It all good though. Trading on Pal days is a little sus anyway. 2:30 in their YouTube page. Is that where we need to go? FederalReserve.com. Yeah. There we go. I read a message in frickin' in the other YouTube chat, and I thought it was my YouTube chat. I'm like, what the hell? Where did that come from? Like, someone's aggressive out there, bro. Hoping Mr. Powell makes the market red. I mean, we'll see. Make sure you guys hit that like button. Appreciate everyone here right now. Mr. Pow Pow will be coming up here in like 40 minutes or something like that. Pow pow. Make sure you guys stay hydrated as well. Hydration is key. Waiting ever so patiently. How's everyone's day going, though? What are you guys up to? What stocks are you looking at? What plays are you in? How's your day? How you feeling? There's 7 people in here. What's up? Are you looking to trade anything today? I usually only trade the SPY, and the level I was supposed to trade was like 5 minutes ago or like 10 minutes ago, and I missed it. So I don't chase trades. If I miss the trade I'm supposed to be going for, then I don't chase it. I either take it in the moment or we leave it. Yeah, sometimes. I don't really trade that much, honestly. I've gotten clapped on a lot of SPY trades recently, so I've been being a lot less frequent on it. Focus more on buying shares. It's a lot more beneficial than wasting time trading. Shares are dope. They don't expire. Minute DraftKings put with $2 profit. Nice. That's a quick trade, bro. $1 a minute though. If you did that every minute, you'd make $60 an hour. Know what I'm saying? That'd be hard, but I don't know. I wouldn't trade like that though. That's funny. Long leaps. Yeah, leaps are dope. Usually when I do trade an option, I'd be sure to get time on it. Time is your friend. Think about poor man's covered call. I don't really like him. I'm not a big fan. I just feel like you're capping the gain on your option that you bought. I don't really like normal covered calls, just because I don't know. If you're gonna buy something like that, like if you're gonna buy an option with all that time, why would you cap your gain by trying to, you know, get a little like $50 from a sell? I don't know. I just don't like it. I'd rather just ride what I'm doing, especially if it was a longer term option. CCS. Are you call it credit spreads? Credit spreads are all right. Will you read the statement? Nah, it's not. That's not this one. That's the Fed minutes you have to read. This one, Jerome will actually tell you what's up. Oh, shit. We got 1 minute till the interest rate decision. There might be a little bit of reading to do, but it's not that much. Oh, covered calls. Nah, I just don't like covered calls because if I had 100 shares of something, I would just want to ride the 100 shares. I wouldn't want to. I've just had 100 shares of stocks before, and too many times has the covered call gone against me, so I don't mess with that stuff anymore. If I have shares that I'm holding long term, I'm just gonna hold them. The only way I would sell covered calls on something I had 100 shares of is if the premiums were like overinflated and the stock was up a lot. You can generate passive income. Yeah, but I don't care about generating passive income. I'd rather hold my assets and not have to sell them back to the market because of a covered call. All right. Issues FOMC statement. As always, Federal Reserve is committed to using its full range of tools to support the U.S. economy in these challenging times, hereby promoting its maximum employment and price stability goals. With progress on vaccinations and strong policy support, indicators of economic activity and employment have continued to strengthen. Market dropped. Banks are ripping. Oh, shit. I wanted to get a SPY trade, but I wasn't even paying attention. I was reading this stupid thing. Oh, well. We'll just wait. Anyway. With progress on vaccinations, indicators, economic activity, the sectors most adversely affected by the pandemic have shown improvement but not fully recovered. Inflation has risen, largely reflecting transitory factors. Overall financial conditions remain accommodative, in part reflecting policy measures to support. Oh, that's all the same shit. The path of the economy continues to depend on the course of the virus. Progress of vaccinations will likely continue to reduce the effects of public health crisis on the economy. That's all the same. The committee seeks to achieve maximum employment inflation at a rate of 2% over the longer run. With inflation having run persistently below the longer run goal, the committee will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. Committee expects to maintain an accommodative stance of monetary policy until these outcomes are reached. Are achieved. The committee decided to keep the range of the federal funds rate 0 to 1/4%. Expects the appropriate maintain this target range until the labor market conditions have reached levels consistent with the committee's assessment of maximum employment and inflation. Has risen 2%, is on track to moderately exceed 2%. Last December, the committee indicated that it could continue to increase its holdings of Treasury securities by at least $8 billion per month, and of agency mortgage-backed securities by $40 billion per month. I should have grabbed that SPY trade. Until further substantial progress had been made towards its maximum employment and price stability goals. Since then, the economy has made progress towards these goals, and the committee will continue to assess progress in coming meetings. These asset purchases help foster smooth market functioning and accommodative financial conditions, thereby supporting the flow of credit to households and businesses. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information from the economic outlook. The committee would be prepared to adjust the stance of monetary policy as appropriate if risks emerge that can impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures and inflation expectations, and financial and international developments. So, there you go. Same frickin' stuff as always. What is this, though? Repurchase agreement arrangements. The Federal Open Market Committee on Wednesday announced the establishment of 2 standing repurchase agreement facilities, a domestic standing repo facility and a repo facility for foreign and international monetary authorities. FEMA repo facility. These facilities will serve as backstops in money markets to support the effective implementation of monetary policy and smooth market functioning. Under the SRF, the Federal Reserve will conduct daily overnight repo operations against Treasury securities, agency debt securities, and agency mortgage-backed securities with a maximum operation size of $500 billion. The minimum bid rate of repos under the facility will be set initially at a 25 basis point, somewhat above the general level of overnight interest rates. Counterparties for this facility will include primary dealers and will be expanded over time to include additional depository institutions. Under the FEMA repo facility, the Federal Reserve will enter into overnight repurchase agreements as needed with foreign official institutions against their holdings of Treasury securities maintained in the custody of the Federal Reserve Bank of New York. The rate of this facility will be set initially at 25 basis points with a per counterparty limit of $60 billion. By creating a temporary source of dollar liquidity for FEMA account holders, the facility can help address pressures in global dollar funding markets that could otherwise affect financial market conditions in the United States. That's new, I think. I'm pretty sure that's new. So hopefully they talk about that in the meeting. because that's interesting. That was the FOMC statement that just got released. Then we're going to be watching young Jerome here in a minute. Damn, bro. You could have made like $40 in 30 seconds if you would have took that SPY trade when I was reading. I was like, should I do it? Nah, I'm going to read this. It's all good, though. We be chilling. Chilling. What does that mean for the market? What do you mean? It's all, everything I read was the same besides the repo facility thing. That should be good for the market, bringing in more liquidity. But I honestly, that's new. I don't know anything about that. I'm pretty sure that's new. I don't think that's... We'll see. We got to hear young Jerome talk about it, if he talks about it. I mean, someone should ask him a question about it. Make sure you guys run up that like button. Much love to everyone here. Mr. Powell will be on in about 20 minutes. Elvis, just drive your frickin' tractor and load up your grain. Pull your little levers and your little gas pedal, push it, and yeah, whatever else you do. Where am I from? I'm from Utah, bro. Where are you from? New Jersey, unfortunately. Why unfortunately? What's wrong with New Jersey? The bonds are going ham. Never mind. I thought it was like ripping. Just kidding. I love it here. There you go. I bet New Jersey's nice. I've never been there. Mr. Powell. 15 minutes? Damn. That's dope. I've never been to New York either. I could imagine that's hectic. I don't know if I could do New York. It seems wild. I should visit New York. I'll have to take your word for it. Anyone I've heard talk about New York, they just say bad shit about it. So I was always just like, I don't know if I want to go there. Lots of fun things to do. Yeah, I bet there is a lot. A lot of people you can talk to. More people than anywhere. I need my VIX calls to burr and interest rates are ass. Well, sorry to tell you, Sean, but that's not how the stock market works. Just because someone opens their mouth and talks about the same shit they've been talking about the past year, maybe 6 months, doesn't mean the market's just going to drop. Like, the market has mechanical... The market operates mechanically is what I'm trying to say. Like, no piece of news, nothing Jerome Powell says, it doesn't matter. Like, everything's already priced in before it even happens. Sure, you get a reaction every time Powell's on for the most part, but it's a small reaction in the grand scope of, or in the longer term picture, I guess. So like, you can't just, oh man, Powell's speaking today, I'm gonna buy fucking a put and some call and a VIX call because Powell's gonna make the market drop. Nah, that's not how it works. Commented that inflation worries are here. That doesn't exactly. That's the point I'm trying to make here. You're so focused on the news, and you think the news has such a freaking weight on the market when it doesn't, bro. Like, everything you're seeing on the news is already priced in. And the only reason you see a short-term move on news and shit like that is because there's so many people in the market that do hold that weight on the news. But if you're focusing on the longer term picture and trying to be consistent, then the news has no benefit. Sure, you get to keep up to date for yourself and all that, but it's it's not a consistent way to trade. Federal Reserve's inflation stance. Yes, it has. They've been talking about inflation for the past 3 months. Everything they've been talking about has already been said. The only thing that's new is that repo facility thing, and I don't even know what that's about. But like, the reason I wanted to buy a call on the SPY when it dropped after that interest rate decision is because it dropped below the level I wanted to trade like 20 minutes earlier. But I still didn't even do the trade because that shit is sketchy as hell. But I mean, as you saw, it would have worked. It's just, I don't know. I wouldn't be trade off of anything like that ever. They're considering to raise rates. No. Dude, do you even watch the Federal Reserve? Like, I watch this every single time, bro. They're not going to raise rates for another year. Maybe year and a half. Like, I don't know what news you're reading, bro, but like I watch this shit every single time. And it's the same thing every single time. And they gave you their guidelines for the next all the way up into 2023. So I don't know where you're getting this news at, but nah, they're not considering it at all. I guess. What is wrong with you, Elvis? Damn AMD. Why don't you like AMD? AMD is great. Do you remember when we bought that at like $75? Why do I watch it so much if you're not trading that much? Because why do I need to trade? Why can't I just invest and be a millionaire and guaranteed? I don't even need to put a time frame on it. I just like sitting here watching the market, hanging out with my people, seeing what news comes through, watching events like this. Like why do I need to trade? I trade the SPY all the time. There's times to do it and times to not. I just don't even really like trading that much. I want to learn about it. Like there's always every day is a learning opportunity when it comes to trading, but it's not my main focus. I'd rather buy long-term shares. Trading it's not easy. It's definitely not easy. There's 15 of you in here right now. Make sure you guys slap that like button. Help other beautiful people like yourselves find the channel. We got about 10 minutes till Mr. Powell comes on. Probably like 15. I'm sure he'll be late, but you know. Open door calls. What's a open door? Whoops. Open. That one looks interesting. I just don't know what open door is. SOS? What is SOS? I'll send an SOS to the world. Trisha? What up, Trisha? How are you? Still laughing about my F up on UEC. You got so lucky. You a lucky boy. Now we about to listen to Powell here in like 10 minutes. Chinese Bitcoin mining company. Gotcha. Good. Glad you're here. Except Powell's coming on soon. But I'm glad you stopped in if you'd stick around for Powell or whatever. I don't know. It's just good seeing you. SOS to the world. I hope someone gets my message in a bottle. Jerome Powell in a bottle. Let's run up those likes. Can we get 15 likes? Run it up. Run it. Run it. Knew the karaoke was going to take off. Nah, it's Jerome Powell, bro. People only come to this stream for Jerome Powell and earnings. Other than that, they don't like me. What's a stock you're heavily invested in? My biggest positions are Facebook and Boeing. But other than that, everything's pretty similar. Like Facebook. Yeah, I mean, Facebook is dope. I was down on it for so long. I'm not sure about Boeing. Yeah, Boeing's a little sus, but I bought it back last March. I think my average cost is like 160 or something. I don't know. I forget all the time. Yeah, 160. So, got it at a decent price. So I can't complain. Definitely could have got it cheaper, but I just bought it late. Electric car charging station funds are in infra deal. Your car charging companies are popping. A lot of the cheese. Those options are already up 100%. Yeah, those all just skyrocketed. I would say ChargePoint would probably be the better move, but all the premiums are up a ton already. I don't think I would play this. The longer term contracts are pretty expensive. I'd honestly just buy shares of ChargePoint. I don't know if I want to do that, though. You could. Should we just buy 10 shares? See what happens? See how a news play works? Nah. We'll wait. They'll lose faith. Sell a cash secured put. Could. You just wouldn't be getting that much. I'd rather just buy the shares if I was going to get it, but I don't think I would even play that. I'd just wait till they get closer to passing the actual infrastructure bill, because they could take that out pretty easily if they wanted. Nah, you usually want to sell a put when the stock's coming down and the options get overinflated. It's not usually a thing you just want to like do casually. At least I don't think. It's the same thing with the covered call. Your most advantageous time is going to be when the prices are high. You have about 5 minutes till Powell. What's EV Go? I don't even know what EV Go is. Humana fell hard. Oh, wow. Humana got clapped, bro. Holy shit. What happened? Do you know? Did they have earnings or something? Or, like, what happened with that? That's insane. Humana's down so much. Jake Waters, my guy. Welcome. Hope you're having a blessed week so far, bro. Blessed day. Earnings. Yeah, that's crazy, though. That's a huge drop. I should probably turn the volume down just in case. There we go. Earnings. Powell be coming in hot. This is why I'm hot. Way green on the day. Nice. That's what's up, bro. That's what I like to hear. There's 16 of you in here. Let's run up those likes. Let's get 15. Run it. Let's get 15 likes before the Powell speech starts. Boy toys, get ready. You know it, baby. I'm trying to watch Powell in private. Why do you think I mute the mic when he's on? You know what I'm saying? I'm just messing around. I'm like, ooh, damn, Powell, you looking good, boy. Mm-hmm. Nothing hotter. Amen. You looking hot tonight? I think he's going to say something good or bad. It's just going to be the same shit. Hopefully he talks about that thing, those facilities I read about. Because I don't know what those are about. But, yeah. Other than that, it's going to be the same shit, as always. It's all fake news. You're fake news. You know that? You ever thought of that? You're fake news. Go trade your U.S. steel. All right? It's popping. Oh, it's been popping. Never mind. Don't trade it. False alarm. Oh, shit. There's Powell.
Maximum employment and price stability. Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to support the economy until the recovery is complete. Progress in vaccinations and unprecedented fiscal policy actions are also providing strong support to the recovery. Indicators of economic activity and employment have continued to strengthen, and real GDP this year appears to be on track to post its fastest rate of increase in decades. Much of this rapid growth reflects the continued bounce back in activity from depressed levels. The sectors most adversely affected by the pandemic have shown improvement, but have not fully recovered. Household spending is rising at an especially rapid pace, boosted by the ongoing reopening of the economy and ongoing policy support. The housing sector remains very strong, and business investment is increasing at a solid pace. In some industries, near-term supply constraints are restraining activity. These constraints are particularly acute in the motor vehicle industry, where worldwide shortages of semiconductors have sharply curtailed production so far this year. As with overall economic activity, conditions in the labor market have continued to improve. Demand for labor is very strong, and employment rose 850,000 in June, with the leisure and hospitality sector continuing to post notable gains. Nonetheless, the labor market has a ways to go. The unemployment rate in June was 5.9%, and this figure understates the shortfall in employment, particularly as participation in the labor market has not moved up from the low rates that have prevailed for most of the past year. Factors related to the pandemic, such as caregiving needs, ongoing fears of the virus, and unemployment insurance payments, appear to be weighing on employment growth. These factors should wane in coming months, leading to strong gains in employment. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been hardest hit. In particular, despite progress, joblessness continues to fall disproportionately on lower-wage workers in the service sector and on African Americans and Hispanics. Inflation has increased notably and will likely remain elevated in coming months before moderating. As the economy continues to reopen and spending rebounds, we are seeing upward pressure on prices, particularly because supply bottlenecks in some sectors have limited how quickly production can respond in the near term. These bottleneck effects have been larger than anticipated, but as these transitory supply effects abate, inflation is expected to drop back toward our longer-run goal. Very low readings from early in the pandemic, as well as the pass-through of past increases in oil prices to consumer energy prices, also contribute to the increase, although these base effects and energy effects are receding. The process of reopening the economy is unprecedented, as was the shutdown at the onset of the pandemic. As the reopening continues, bottlenecks, hiring difficulties, and other constraints could continue to limit how quickly supply can adjust, raising the possibility that inflation could turn out to be higher and more persistent than we expect. Our new framework for monetary policy emphasizes the importance of having well-anchored inflation expectations, both to foster price stability and to enhance our ability to promote our broad-based and inclusive maximum employment goal. Indicators of long-term inflation expectations appear broadly consistent with our longer-run inflation goal of 2%. If we saw signs that the path of inflation or longer-term inflation expectations were moving materially and persistently beyond levels consistent with our goal, we'd be prepared to adjust the stance of policy. The effects of the pandemic on the economy have continued to diminish, but risks to the economic outlook remain. Progress on vaccinations has limited the spread of COVID-19. However, the pace of vaccinations has slowed, and the Delta strain of the virus is spreading quickly in some areas. Continued progress on vaccinations would support a return to more normal economic conditions. The Fed's policy actions have been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As the committee reiterated in today's policy statement, with inflation having run persistently below 2%, we will aim to achieve inflation moderately above 2% for some time so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect that it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we are continuing to increase our holdings of Treasury securities by at least $80 billion per month and of agency MBS by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. Our asset purchases have been a critical tool. They helped preserve financial stability and market functioning early in the pandemic, and since then have helped foster accommodative financial conditions to support the economy. At our meeting that concluded earlier today, the committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition once economic conditions warrant a change. Participants expect that the economy will continue to move toward our standard of substantial further progress. In coming meetings, the committee will again assess the economy's progress toward our goals, and the timing of any change in the pace of our asset purchases will depend on the incoming data. As we've said, we will provide advance notice before making any changes to our purchases. On a final note, we announced the establishment of 2 standing repo facilities, a domestic one for primary dealers and additional banks, and another for foreign and international monetary authorities. These facilities will serve as backstops in money markets to support the effective implementation of monetary policy and smooth market functioning. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I look forward to your questions.
Thank you. Let's go to Steve Leisman with CNBC.
Thank you very much. Mr. Chairman, I wonder if you might be able to put some, numbers or maybe more detail around this concept of substantial further progress. What counts as the progress numerically, if you will, or citing data, if you could, that you cited in the statement today? And if you could be more specific about what substantial further progress would look like, and if that would then lead you to an announcement of an actual reduction in the purchases of your assets. Thank you.
Great, thank you. So, more detail on substantial further progress. So, let's talk about the maximum employment part of that. As you know, with maximum employment, unlike with price stability, where we can target a number 2% on average, with maximum employment, there isn't a single number that we can target. We monitor a broad range of data about different aspects of the labor market. There's unemployment among different age groups and such. There's participation, there's wages, there's all kinds of flow data, and we look at all of it to try to arrive at a picture of what is maximum employment. So there isn't. I can't give you a set of numbers. For example, a numerical threshold like we used for a time back in 2012, I guess it was. We didn't do that here. What we said was substantial further progress toward our goals, and what we said was we would keep effectively we would give advance warning as we and more and more clarity as we move forward. And that's what we're going to try to do. So what would substantial further progress be? I'd say we have some ground to cover on the labor market side. I think we're some way away from having had substantial further progress with with toward the maximum employment goal. I would want to see some strong job numbers, and that's kind of the idea.
If I could follow up, you talked about one side of the equation. You didn't. Does it mean you feel like you've reached your goal when it comes to the inflation side? Thank you.
So inflation is running well above our 2% objective and has been for a few months, and is expected to run up certainly above our objective for a few months before we believe it'll move back down toward our objective. The question whether we've met that objective formally is really one for the committee to make. I can't do that by myself, but it's clear that at this time inflation is actually running above 2%, and again has been and will be, at least we expect it will, in coming months before returning down toward our target.
Thank you. And Saphir with Reuters.
Hello, can you hear me? Hello, can you hear me? I'm sorry.
Yes, we can hear you.
I apologize. I just to follow up on the question, I want to ask, is it correct to see this as the start of the advance notice process, before a taper, and also, can you speak to how the recent surge in COVID factors into your thinking on the taper? Thanks.
So, as you know, we're in a process now where what we said is that as at this meeting and in coming meetings, we're going to be continuing to assess the economy's progress toward our goals and give advance notice. We'll be trying to provide additional clarity about our thinking, both in the post-meeting statement and in the minutes and in the public comments that people make. Our approach here has been to be as transparent as we can. We have not reached substantial further progress yet, so we're not there, and we see ourselves as having some ground to cover to get there. So that's what I would say. In terms of COVID and the Delta strain, I'll say a couple things. Of course, it will have significant health consequences for many, and we need to keep that in mind before we mention and move to the economic questions. This is rising cases in a number of parts of the country, and some forecasts are for them to rise quite significantly. We'll see. What we've seen, though, is with successive waves of COVID over the past year and some months now, there has tended to be less in the way of economic implications from each wave, and we will see whether that is the case with the Delta variety. But it's certainly not an unreasonable expectation. So it certainly is plausible that people would pull back from some activities because of the risk of infection, dining out, traveling. Some schools might not reopen. We may see economic effects from some of that, or it might weigh on the return to the labor market. Some people might choose. Again, we don't have a strong sense of how that might work out, so we'll just be monitoring it carefully.
Thank you. We'll go to Nick Timros at the Wall Street Journal.
Hi, Chair Powell. Nick Timros at the Wall Street Journal. In your opening statements in March and April, you noted that a transitory rise in inflation above 2% this year would not meet the threshold of moderately exceeding 2% for some time. And I noticed you didn't repeat that qualification last month or today. And so in your view, has the rise in inflation this year met the threshold of moderately exceeding 2% for some time?
That would, again, be a question for the committee, but I would really say the guidance that you're talking about is really the guidance to do with liftoff, right? That's what the guidance is for liftoff. We had to have labor market conditions consistent with full employment, inflation at 2%, and on track to run moderately above 2% for some time. It really isn't relevant now, because we're looking at tapering asset purchases. We're clearly a ways away from considering raising interest rates. It's not something that is on our radar screen right now. So when we get to that question, when we start to get to the question of liftoff, which we are not at all at now or near now, that's when we'll ask that question. that is one that will become a real question for us.
Great, thank you. Gina Smialek at the New York Times.
Hi, Chair Powell. Thank you for taking our questions. I wonder if you could talk a little bit about reacting. Does that affect how you're thinking about tapering? Does it affect how you're thinking about, potential liftoff down the road? And if you could just talk a little bit about that.
Gina, I'm sorry, for the first 15 seconds of your question, you froze. Could you say that again? I apologize.
Oh, yeah, no, sorry. So I was wondering if you could talk a little bit about how the divergence in global growth and the sort of multi-speed recovery we're seeing around the world impacts how the Fed thinks about its policies. So do you take into account that sort of multi-speed recovery when you're thinking about tapering QE, and do you take it into account when you're thinking about liftoff?
Thanks. So it's an important feature of this recovery is how uneven it is, and in many cases it's related to the fact that some countries have had little in the way of access to vaccines, and so they're seeing significant outbreaks and it's weighing on economic activity, whereas other countries, such as the United States in particular, are having a very strong rebound. And now Europe is having a stronger rebound as well. So it's a feature of our economy. Now, how does it affect our policy? In a couple of ways, potentially. One just is that in general, economies and through financial markets and through trade are deeply interconnected now. And so a stronger global economy will lead to more U.S. exports, and that'll help economic activity. To the extent the global economy is weak and the United States is strong, we'll wind up exporting some of our demand through imports rather than having a lot of exports. That's one way. Another way, though, is more on the risk side, and that is as long as COVID is running loose out there, as long as there's time and space for the development of new strains, no one's really finally safe. These strains, there's no reason they just can't keep coming, and one more powerful than the next. We don't know that, but that's certainly a plausible outcome. Now, as vaccinations rise, we can nonetheless get back to our economic activity. But it is both the right thing to do and very much in our interest to make sure that vaccination happens broadly around the world, just for that reason.
Thank you. James at the FT.
Thank you very much. Chair Powell, how would you describe the risk to the outlook on inflation at the moment after the last data came out higher than expected? Do you believe the risks are tilted to the upside? And does the committee share that view, or are they in balance? Are you still worried that there could be a hit to demand from the Delta variant that could tilt them sort of to the downside again? If you could give us a sense of that, that would be very helpful.
Sure, I'd be glad to. So if you look at the most recent inflation report, what you see is that it came in significantly higher than expected, but essentially all of the overshoot can be tied to a handful of categories. It isn't the kind of inflation that's spread broadly across the economy. It's new, used, and rental cars, it's airplane tickets, it's hotels, and it's a couple of other things. And each of those has a story attached to it that is really about the reopening of the economy. So we look at that and we think that those are temporary things because the supply side will respond, the economy will adapt. We have a very adaptable, flexible economy and labor market, and it's a real asset that we have. And so we think that inflation should move down over time. Now, we don't have much confidence, let's say, in the timing of that or the size of the effects in the near term. I would say in the near term that the risks to inflation are probably to the upside. I have some confidence in the medium term that inflation will move back down. Again, it's hard to say when that will be. I will say though that inflation is half of our mandate, price stability is half of our mandate, and if we were to see inflation moving up to levels persistently that were above, significantly, materially above our goal, and particularly if inflation expectations were to move up, we would use our tools to guide inflation back down to 2%. So we won't have an extended period of high inflation. We think that some of it will fall away naturally as the process of reopening the economy moves through, and it could take some time. In any case, we will use our tools over time as appropriate to make sure that we do have inflation that averages 2% over time.
Thank you. Victoria at Political.
Hi, Mr. Chairman. So bond market pricing seems to suggest that investors think the Fed might eventually over-tighten. So my question is, do you think that markets have bought into the central bank's new framework, and how do you balance that with managing inflation concerns?
Well, so in terms of what's been happening in bond markets, I don't think there's a real consensus on what explains the moves between the last meeting and this meeting. We've seen the long-term yields go down significantly. Some of it is a fall in real yields, which may have been connected to, some speculate, connected to sentiment around the spread of the Delta variant and concern about growth. There was also some decline in inflation and compensation, which is significantly reversed. And there are also so-called technical factors, which is where you put things that you can't quite explain. So I don't see in any of that there is really anything that challenges the credibility of our framework, if that's really your question. We are committed to achieving 2% average inflation over time. What we said was that, in particular, when we see a very strong labor market, high levels of employment, low levels of unemployment, that won't be enough for us to raise interest rates until we see some inflation. Of course, what we have today is kind of the opposite. We've got 7 or 8 million people, fewer people at work than were at work before the pandemic. So we're a ways away from full maximum employment, but we have high inflation. So it's kind of the opposite case, and we have to deal with that. Any central bank has to deal with that by looking at the inflation and asking whether it is broad-based and likely to be persistent, and whether inflation expectations are implicated in a way that could cause them to rise. So we're monitoring that very carefully, and we're prepared to use our tools as appropriate. But again, I think our framework is pretty well understood, and I think the real test of it will be down the road when it's time to think about raising interest rates and how we assess that set of issues.
Thank you. We'll go to Rich at Bloomberg.
Thanks very much, Michelle. Chairman Powell, you just alluded to the fact that you're prepared to use your tools to slow the economy down if need be, if inflation looks like it's getting out of control. I want to just try to understand that in the context of the framework and the forward guidance. Does that mean you'd be prepared to raise interest rates even if we're not at maximum employment at that point? Should you see this danger of inflation? And two, does it also mean you'd be prepared to raise interest rates even if you are still buying assets? Thank you.
So there's a part in our statement on longer run goals and monetary policy strategy, which, Rich, I'm sure you're familiar with, which talks about that case in which the two goals are in tension. Most of the time, if you have high inflation, you also have high employment. They tend to go together. This is a situation where they're temporarily in different directions. We're not at full employment, but we are having high inflation. We feel like we're going to be making good progress over the course of the next couple of years, really, toward maximum employment. This is a very strong labor market. If you look at the number of job openings compared to the number of unemployed, we're clearly on a path to a very strong labor market with high participation, low unemployment, high employment, wages moving up across the spectrum. That's the path that we're on, and it shouldn't take that long in macroeconomic time to get there. So that's what I think is really the likely case. Again, it's not timely for us to be thinking about raising interest rates right now. What we're doing is we're looking at our asset purchases and judging what is right for the economy and judging how close we are to substantial further progress, and then tapering after that. And then the question you ask about would we raise rates if we hadn't finished the taper, hypothetical question. We'd face the circumstance at the time. We could always just, one thing one could do would be to just cut asset purchases all the way to zero if you wanted to do that. But it's just hard. It's hard to answer what you would do without knowing a lot more about the situation. Ideally, you wouldn't be still buying assets and raising rates because, of course, you're adding accommodation by buying and removing accommodation by raising rates. So that wouldn't be ideal. I'll say that.
Thank you. We'll go to Edward Lawrence at Fox Business.
Thank you, Mr. Chairman. Thank you, Mr. Chairman, for taking the question. So you talk about jobs. You just said that we're on a path to a very strong job market. We have 9.5 million people unemployed as of the last labor market survey, and 9.2 million job openings. So what's the disconnect? Is it a skills gap? Is it the extended unemployment benefits? Is it the fact that people just aren't willing to relocate? What is the disconnect there?
It's a really unusual situation to have the ratio of vacancies to unemployed be this high, and we think there are a number of things at work there. Maybe the place to start is just to say that this is now not so much about people going back to their old jobs, it's about finding a new job. So that's a time-intensive, labor-intensive process, and there may be a bit of a speed limit on that. There's research that suggests that there is a speed limit on that. So it's not like you can have millions of people at the beginning of the recovery going back in a single month because they're just going back to their old jobs. This is about job selection, things like that. There may also be some factors that are holding people back, and this is what surveys say. There are people who are reluctant to go back to work because they still feel exposed to COVID. These could be jobs where there's a lot of interaction with the public, and where perhaps there's a family member who's vulnerable or for whatever reason. There's also caretakers where schools are not fully open and parents are at home. Or taking care of older people. And there's also been very generous unemployment benefits, which are now rolling off. They'll be fully rolled off in a couple of months. And all of those factors should wane. And we think we should see, because of that, we should see strong job creation moving forward. I mean, ultimately, it's unusual to see aspects like the job openings number in a context where there are that many unemployed people. That many job openings would typically suggest a tight labor market. And of course, we hear from businesses all over the country that it's very hard to hire people. And that may be because people are shopping carefully for their next job. I mean, I think the bottom line on this is people want to work. If you look at where labor force participation can get, people will go back to work unless they retire. Some people will retire, but generally speaking, Americans want to work, and they'll find their way into the jobs that they want. It may take some time, though.
Thank you. Rachel Siegel at the Washington Post.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. I wanted to follow up on what you said about there tending to be less in the way of economic implications from each wave of COVID cases. Could you elaborate on what you've seen to that end during previous waves? And then looking forward, how vulnerable is the labor market to the Delta variant? I'm thinking or wondering if you have concerns that jobs that may have come back in travel or tourism could be susceptible if people started reconsidering their travel plans, or if caretakers were suddenly faced with the prospect of schools not reopening. How do you see some of those risks going forward? Thank you so much.
Sure. So if you remember the summer wave last year of COVID, which was largely southern and western states, the economy just performed much better than anyone expected. We were coming off the spring wave where there were a lot of shutdowns, and then this big second wave hit. And I think the natural thing to do is to expect that it would have a real impact on the economy. It was much less than people thought. People learned, what's happened is, first of all, many people are vaccinated. They're going on with their lives. Secondly, we've kind of learned to live with it. A lot of industries have kind of improvise their way around it. Particularly, for example, buying a new home. That process of buying a new home very quickly moved to much more of a virtual process, and so they were able to to do that. And other industries as well have gone to takeout and no contact things. It's so that can all. It seems like we've learned to handle this now. I think people would like to get back to the way things were. And I hope to some extent we will over time. Of course, the big wave we had last winter did have significant employment effects, particularly in hospitality and leisure and other entertainment, other areas with a lot of direct contact. A lot of jobs were lost in that because that was a very strong wave that happened in the winter months last year, just before the vaccines arrived. So with Delta, we're just going to have to watch again with a reasonably high percentage of the country vaccinated, and the vaccine apparently being effective. We're not experts on this, but it seems like a good going in estimate would be that the effects will probably be less. There probably won't be significant lockdowns and things like that. But again, those are not decisions for us, or nor is it something we'd be expert in. In terms of the channels, this is kind of speculation, but it just is that people, you could imagine school districts deciding to wait a month or two for the Delta wave to quiet. I'm not saying this will happen, but that it's easy to imagine that. It's also easy to imagine that some people might say, you know what, I'm just gonna wait a couple of months before going back to work. Wouldn't be hard to imagine that happening. If schools don't open, then caretakers have to stay home, and if people don't go back into the labor force, then the job growth won't be as strong. Those kind of things. So it doesn't. Again, sitting here today, not being able to really know the future, it doesn't seem as though the effects will be very large. But there may be effects, and it may be that the effect is to slow the economy down just for a period of months, or not. There are many parts of the country where it might not have an effect, and we're just going to have to see what the economic effects are.
Thank you. Now we'll go to David Gura at NPR.
Thank you, Mr. Chairman. I was going to ask if you've started drafting your Jackson Hole speech, but I'm going to go in a different direction here. Steve Leisman asked you about semantics, and I'm going to take a cue from him and ask you about the term transitory, because I think of you as somebody who so lucidly explained policies and programs in recent months and made a real concerted effort to explain them to the American public as a whole. I wonder about this term and what you would say to people who don't know it definitionally, don't know what it means, and see prices going up and wonder how long they're going to have to wait. So just some broader definition from you, I'd like to hear just about what it means or how you understand it. And quickly as well, you've talked about vaccines a bit, and your colleague in Minneapolis has placed a mandate on vaccinating employees coming back to that Federal Reserve Bank. And I wonder if that's something that you would like to see or expect to see system-wide going forward.
The concept of transitory is really this. It is that the increases will happen. We're not saying they will reverse. That's not what transitory means. It means that the increases in prices will happen. So there will be inflation, but that the process of inflation will stop, so that there won't be further. When we think of inflation, we really think of inflation going up year upon year upon year upon year. That's inflation. When you have inflation for 12 months or whatever it may be, I'm just taking an example and not making an estimate, then you have a price increase, but you don't have an inflation process. And so part of that just is that if it doesn't affect longer-term inflation expectations, then it's very likely not to affect the process of inflation going forward. So what I mean by transitory is just something that doesn't leave a permanent mark on the inflation process. Again, I don't mean that producers are going to take those price increases back. That's not the idea. It's just that they won't go on indefinitely. So to the extent people are implementing price increases because raw materials are going up or labor costs or something's going up, the question really for inflation really is, does that mean they're going to go up the next year by the same amount? So you're going to be in a process where the inflation process gets going, and that happens because people's expectations about future inflation move up. And we don't think that's happening. There's no evidence that it's happening. All the evidence is that it's not happening. But nonetheless, we have to watch this very carefully because this is, we have two mandates, maximum employment and price stability. Price stability for us means inflation averaging 2% over time. And so we've got to be very careful about that. But I think it's a good point that it's a term. What it really means is temporary. But then you got to understand that it doesn't mean that the increases will be taken back. Some of them will be, but that's not really what it means. In terms of, so we're working virtually here, and we'll be coming back down the road in a couple of months, starting to bring people back here at the Board of Governors in Washington. And, we're going to follow public health guidance and things like that. We really haven't made the fundamental decisions about exactly what that will look like, and it'll depend to some extent on what CDC guidance looks like when we actually do bring people back in.
Thank you.
Thank you. We'll go to Michael McKee at Bloomberg TV.
Chairman, I wanted to ask you a little bit about your taper timeline in the sense that you said you want a couple more months of data, and the statement says that the Fed is going to use to evaluate the developments in the two markets in jobs and inflation in coming meetings. Does that suggest that we wouldn't see anything before September or November in your meetings? And I know a lot of people on Wall Street have basically felt you're going to lay out your taper plans at Jackson Hole. Is that the plan, or are we not going to see anything until the fall?
So we made any decisions about the timing, and I did not. If I said we're looking at a couple more months of data, I'm not meaning to suggest anything about a particular time at which we might taper, because we really have not made that decision. All I'm saying is that we're not at substantial further progress. There's a range of views on what timing will be appropriate, and those views ultimately track back to people's views about the economy and what will happen as we make progress towards our goal. So that's really what it is. And we will, of course, as we're going to continue to try to provide clarity as appropriate on timing, pace, and composition. But today I've given you what I can give you, because again, this was the first really, I would say, deep dive on the issues of timing, pace, and composition. And it was a good meeting, but no decisions are made, and I'm just not in a position to give you much guidance, really any guidance on the actual timing. But I will say we're making progress. We expect further progress, and we expect that if things go well, then we will reach that goal. And when we reach it, and the committee is comfortable that we have reached it, then we'll taper at that point. I really, there's nothing I can say about Jackson Hole. We're in the process of writing that speech, and I am going to give a speech, but I wouldn't want to say what'll be in there at this point.
Well, if I could follow up, several people have recently noted that the Fed has got the markets working well, and you've got bank loans up. In other words, you've stimulated demand. But savers and companies like insurance companies and pension funds are getting hammered by the low rates, and they're wondering if the balance hasn't started to shift away from benefiting the economy to doing more harm than good.
Asset purchases were just a key part of our response to the critical phase of the crisis. They really helped us restore market function to these key markets, really, which are very, very important to our economy and the global economy. And then they were a big part of creating accommodative financial conditions to support demand. They were strongly needed. It was that commitment to continue asset purchases that provided strong support for the economy and has been a part of the story for why the economy is so strong right now. So we said we would taper when we achieve substantial further progress, and we're going to honor that commitment. I mean, it's and again, we're talking about it right now, and meeting by meeting, and moving in that direction. We will taper when we reach that goal, and we'll provide more clarity on that as we go, as is appropriate.
Thank you. We'll go to Hannah Lang at the American Banker.
Hi. You've been asked a lot previously if the Fed's monetary policy at all contributes to inequality, but I was really curious to know where you think the Fed's regulatory policy lands, particularly if you think that the Fed's bank capital requirements have had the effect of penalizing lower income households seeking loans. Basically, is it possible to achieve the balance of a safe banking system with one that also provides equitable loan access? Thanks.
Well, I think strong capital requirements are essential for banks, particularly for the largest banks. And I think that an undercapitalized banking system, as we've seen, can be a real threat to the economy and mostly, or to the greatest extent, to people at the lower end of the income spectrum. So if you look back at not this crisis, but the previous one, the banking system was undercapitalized. So higher capital requirements are really a good thing because they allow banks to weather downturns and continue to perform the functions that they perform. I think it's other tools that we have to, and the Fed has some of these tools, Congress has some of these tools, other agencies have some of these tools to assure or support the wide availability of credit, particularly to low and moderate income communities. So that's CRA. We enforce CRA. We're working on a new CRA proposal right now with the other banking agencies, and we think it's going to be good, and will support the flow of credit to low and moderate income households. It's also the anti-lending discrimination statutes that we enforce. And it's some of the programs that Congress has in place to support the flow of credit to low and moderate income communities. I don't think it's capital standards at all. I think capital standards work the other way. Strong capital is what enables banks to continue to serve their communities, including low and moderate income communities.
Thank you. We'll go to Chris Rugaber at the AP.
Hi. Thank you for taking my question. Chair Powell, I guess I wanted to ask about the last when you were before Congress earlier this month, you mentioned, I think, something along the lines of, it won't take too long before we see if you're right about inflation and its temporary aspect. You also mentioned learning a lot more in the next 6 months about the economy. Can you tell us a little more what you mean by that? When do you think you'll get a clean reading on inflation that is free of most of the distortions that we're seeing now?
Right. So with inflation, as I mentioned, we look not just at the headline number, but we look at all the components that go into the calculation of inflation. And if you do that, if you look under the hood, what you see is not that widely across the whole range of goods and services that are in the economy, we're seeing upward pressure on prices. That's not really what we're seeing. What we're seeing is a handful of things that really account for the overshoot of inflation. And as I mentioned, it's things like cars, new, used, and rental cars have moved up in price because of the car shortage, because of the semiconductor shortage. And hotels and airfares have moved back up, but that really just is retracing the very large downward movement in prices that they had before. So that's a big part of why the inflation readings are so high, and those frankly don't carry significant implications in the long run for inflation or for the American economy. So what I said was, we're going to see whether these things. We don't need to see everything do what lumber prices have done. So if you look at lumber prices, they went up and then they went down. So what we want to see is these other things. Do the prices flatten out? Do they actually move down? If they flatten out, then their contribution to inflation becomes zero over time. So they're not contributing to inflation. And so if we start to see those things happen fairly widely among the things that have really moved up quickly, then they won't all happen at once or happen quickly, but we'll know that our basic understanding of the situation is broadly correct. And I don't think it will take, what I said was, I don't think it'll take a very long time to see whether that's the case. It is probably the case that, frankly, the overall reopening of the economy is going to play out over a period of time. This is a world historical event that the global economy is now reopening. It's not going to happen quickly. It's going to take some time, and it's going to be very uneven, as we discussed before. But I think we will know, when we know. But I don't think it will take that long. I don't want to put a number on it. But I do think that if we see those things happening, we'll know that we have the story basically right.
Thank you. We'll go to Brian Chung at Yahoo Finance.
Sure. Hi, Chairman Powell. Brian Chung, Yahoo Finance. Just wondering if you could provide a little bit more color in terms of how you're thinking about mortgage-backed securities purchases as you inch towards taper. Within the context of home prices continuing to rise, we've heard a lot of people talk about the idea that maybe they'd like to cool off on specifically the MBS purchases. Is that more because of the optics, or is it because there's an observed relationship from the committee's view between MBS purchases under QE and a hot housing market? Thanks.
So a number of participants raised the questions around MBS and tapering at today's meeting, as a matter of fact, and yesterday's meeting. And I'll just say that, generally speaking, I think the Treasury and MBS purchases affect financial conditions in very similar ways. There may be modest differences in terms of contribution to housing prices, but it's not something that's big. So where I think we are is there really is little support for the idea of tapering MBS earlier than Treasuries. I think we will taper them at the same time. It seems likely based on where people are now. The idea of reducing MBS purchases at a somewhat faster pace than Treasuries does have some attraction for some people, others not so much, and I think it's something that we'll be continuing to discuss.
Thank you. Let's go to Michael Derby.
Thank you very much. Yeah, so I wanted to ask you about the standing repo facility and get your sense of what you think it will do for market trading conditions, and also kind of in a semi-related point, the reverse repo numbers have just gotten even bigger since you raised the reverse repo rate at the last Fed meeting. And, are you concerned to see, nearly $1 trillion a day, pouring in through that facility?
So on the standing repo facility, what is it going to do? So it really is a backstop. So it's set at 25 basis points, so out of the money, and it's there to help address pressures in money markets that could impede the effective implementation of monetary policy. So really, it's to support the functioning of monetary policy and its effectiveness. That's the purpose of it, and it's set up with that purpose in mind. Your question on the RRP. So we think it's doing what it's supposed to do, what we expect of it to do, which is to help provide a floor for money market rates and help ensure that the federal funds rate stays within the target range. It's essentially what's happening is that it just results in a lower aggregate amount of Federal Reserve liabilities that are in banks in the form of reserves and a higher amount of Federal Reserve liabilities in money market funds in the form of overnight RRP balances. So that's all that's really happening there. And we expect it to be high for some time. It's being driven, of course, by the relatively lower quantity of Treasury bills and also the onset of the debt ceiling and the decline in the TGA, things like that. So we don't have a problem with what it's doing. It's kind of doing the job we expected.
And you don't see any issues with like disaggregating, markets from, investing in private money market securities? Like the idea that the Fed's footprint in money markets is getting too big. You don't see any issues there?
Not really, not at this point. Private money market funds are choosing to invest because the rates are attractive. At some point, the rates will not be so attractive as the whole rate cluster normalizes, and you'll see it shrink back down.
Okay, thank you.
Thanks. Let's go to Greg Robb at MarketWatch.
Hi, thanks for taking my question. Chair Powell, I was going to go back to inflation a little bit. I'm kind of surprised by your tone. It seems like you're just sort of warning that if inflation gets too high, the Fed will act. Isn't it true that, I mean, a little inflation is good for the economy, and that it's somehow maybe we can get the economy out of this sort of place where we're always going to be close to the zero lower bound? Isn't there a good story to tell, and you're sort of panicking people?
I certainly don't have that in mind. No, look, we, as you know, we're targeting a moderate overshoot of 2% inflation for some time. We want inflation expectations to be centered on 2%. We feel like they may be a little bit below that. So the bigger picture is that that would be a healthy thing. This is a different thing. This is not that. That was the kind of inflation we were thinking about that comes from from a very, very strong labor market and a booming economy. Maybe that was the kind of inflation. This is something different. This is really driven by the supply side, which is not able to handle this big spike in demand that we're seeing as the economy reopens with vaccination and fiscal support and monetary policy support. The supply side, just all over the world, you're seeing the same thing, which is it just can't keep up. And there are labor shortages in a lot of places, the same sort of thing. So, there's absolutely no sense of panic. I've explained, I think, several times here today that my best estimate is that this is something that will pass. It's really a shock to the economy that will pass through. If you look at where forecasters are, people who actually write down a forecast for a living, very, very strongly, they see it that way. Now, we're actually responsible for this, though, so we have to take seriously the risk case, which is that inflation will be more persistent, that it might actually move inflation expectations up, and that we might that the kind of things that might require a response. We don't see that now, but we have to be on the alert for it, and people have to understand and believe that we will react if we need to, and we will. But again, it's not my base case. My base case is as I've said repeatedly, is that inflation will move back down. And no, we're not. We have not at all changed our view, and I haven't changed my view that inflation running above 2%, moderately above 2%, is a desirable thing. This is not moderately above 2%. This is well above 2%, but it's also not the kind of inflation we were looking for. This is really driven by a supply side shock.
Thank you.
Thank you. We'll go to Don Lee at the Los Angeles Times for the last question.
Hi, Chair Powell. Wonder if you could talk about wages. Many workers seem to have gotten some good wage gains in recent months. What can workers generally expect going forward? And it doesn't sound like you're concerned about rising wages feeding into broader inflation. Is that right?
So wages have moved up. A lot of that is driven by new hires, and a lot of it is driven at relatively low-paid jobs in the service industries as people come back. So that's not troubling. And we don't see there is a form of wage inflation that can lead to price inflation, and we're not seeing that right now. And that really is if what we call unit labor costs move up, and which really puts it move up in a way that is hard for companies to manage and puts them in a situation where they have to accept substantially lower margins or raise prices. Now, when it happens gradually, we've seen in a long expansion, sometimes unit labor costs do move up and put some pressure on margins. In a long expansion, that's been happening late in the expansion. That's not a problem either. The problem is if it happens in a way that pushes firms broadly into raising prices. It was called the wage price spiral. We don't see that now. This is something that was a feature of the high inflationary era of the Great Inflation, but it's not a feature now, and we don't see that now. Of course, we'll be watching it, and this is one of the reasons why we're watching so carefully to see whether labor force, whether people do come back in and accept jobs, given the very large number of job openings and the very large number of unemployed people, we'd like to see, some matching going on there so people get back to work. We think labor supply would be a healthy thing. But wages moving up across the spectrum, consistent with inflation and productivity, is a good thing.
Thank you, Chair Powell, and thank you all for coming.
Thanks very much.
Is lit. Is lit. Our boy Powell with another meeting. I was kind of disappointed they didn't really talk too much about the new facilities, but it's whatever. It's whatever. Well, I hope you guys enjoyed that. Make sure you hit that like button. We got about 35 minutes till the market closes. Got some action with that SPY. Nice. Noise. Says we've detected copyrighted audio in your stream. What do you mean? We're only listening to Powell. What is this? Why are you lying? Your karaoke? I don't know. I don't think so. We've been singing since day one and never had that happen. YouTube is rude. Very rude. Be sure to stick around for Facebook, Ford, PayPal, Qualcomm, ServiceNow, and a bunch of other earnings after this. Here in about 30 minutes. Stop sells on AMD. Do you have a play on that or something? Under 75. Nice. Too many tags to type in. Why didn't I just do this? So I'm gonna buy back in. I think we're all looking for that. Everything's just ripping though. I wouldn't get the hopes up too high. Got about 25 minutes till the market closes, and then we got our earnings. Shit, so we can get those numbers. Facebook's at 374. I feel like Ford could be decent for earnings. I just don't think I want to play it. Fucking whip BIG, it ain't safe. I think what'll be the move, though, is if Ford reports good earnings and the stock falls off, you might be able to pick up some leaps for really cheap. Probably not, but maybe. I don't think the premiums would decay like it does on other stocks. But we will see. I just don't like playing Ford options. They're so slow. They're so slow. You need crypto? Nah, I don't touch crypto. I would trade it, but I don't even trade it. That's the only thing I would do. I don't think I would hold it long term. Needs to get cheaper before I buy long term. Missing out. I'm not missing out on nothing. Selling that Ford Lightning. Yeah, that Ford Lightning will be legit. I'd have to get 2023s then, which they're pretty cheap. We'll see. I'd actually probably just buy in the money. I don't know. Keep an eye on that one. Just because you can get 2023s for pretty cheap. Yeah, I guess they're not that cheap actually. Facebook. Facebook's going to be interesting earnings. Why are these contracts so cheap? The heck? Buy put on Facebook. I mean, they're really cheap. For some reason, all the prices dropped crazy. I would want to play at the money ones though. Like, you're just spending so much. I'm not gonna buy an out of the money that's not even gonna hit. What's MLNK? Damn. Should have been paying attention to Facebook yesterday. You could sell these pretty far out of the monies for quite a bit of premium. Damn. The next weeks were even crazier. What the heck? We should have been selling Facebook puts yesterday. That's crazy. $30 move was $400 yesterday. Shit. You got the 300 for the 340? That's insane. Should have been freaking paying attention. Those are crazy. Got about 15 minutes till the market closes. $350? Jeez, you spent a lot, bro. Why would you spend that much on an earnings play? That's insane. You spent $300 on an earnings play, bro? I mean, at least you're getting it at a discount, but shit, that's out of hand, bro. All I can say is good luck, sir. How I hit my home runs? By gambling your money? On an earnings play? I wouldn't call that a home run. I would call that getting lucky. It's mathematics. Yeah, I guess. You're just assuming you're going to hit 1,000% on the play. It's not actually going to happen unless it happens. So, I don't know. Like I said, good luck. I don't know why you would gamble that much on an earnings play, though. That's all I'm saying. About to sell it on 180. Well, okay. Good for you. I don't really know what you want me to say. Like, I don't I don't care about your account size or anything. You still gambled $300 on an earnings play. That doesn't nothing else change that fact. You got about 10 minutes till the market closes. Mm-mm-mm-mm-mm. All right, let's get some charts up here. Put forward on that one. PayPal. Facebook. What was the other one? Oh yeah, Qualcomm. Quali World. Five more minutes. SPY's dropping, coming into the close. Three more minutes. You also have Service Now after hours. That one could be interesting. They've been killing it. I'm sure the options are quite expensive. Clowns wouldn't hire me. Who, Service Now? You tried to work for Service Now? I feel like we've talked about this before, but I don't remember. Ghosted. Ghosted. 30 more seconds. Where's the SPY? $20 more seconds. 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Ding 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 ding. Where's the bell? Where'd that bell? Oh, I don't have the other application open, that's why. That's the end of the day. Let's go. Let's go. I think Qualcomm already reported. They're popping. Just waiting for the numbers. Qualcomm is real popping. They're killing it. Where's those Qualcomm numbers? Ah, there they are. Qualcomm Q3, 192 versus 1.67 estimated. Revenue, 8 billion versus 7.58 billion. So Qualcomm wrecked it. I'm not sure what the stock was pricing in. Now we're waiting on PayPal, Facebook, and Ford. Make sure you guys hit that like button if you have not. Appreciate you all being here. I think Align just reported. I didn't know they were reporting. Yeah, Align reported net revenue 1.01 billion, estimated 947.4 million. Doesn't say their EPS on that one. I'm sure I could find it. Qualcomm says it has more demand than supply in all products. Qualcomm CEO says supply to improve by end of the year. I'm not seeing Align's EPS. Align fiscal year net revenue 3.85 billion to 3.95 billion. Saw 3.7 to 3.9. Qualcomm still ripping. Align EPS beat by 50 cents. I'm not seeing their numbers still, though. Oh, EPS 3.04. Estimated 2.55 for Align. Qualcomm still going. Damn, Qualcomm 147. Dude, Qualcomm is killing it right now. Facebook isn't out yet. Just wait. Hologic. I don't know what Hologic is. EPS 1.33. Estimated 1.12. Sales 1.17 billion. Beats 1.04 billion. What was that one? Holex. Holex not moving. There's Ford. I think Ford's out. Facebook dropping. Damn, Facebook getting clapped. Facebook was pricing in like a $15 move, though. So we should be seeing a little more than that. Facebook tanking. You just waited in here all day to say that. What'd I say? Like I said, you got lucky and you gambled $300 on an earnings play. I don't know what you want me to say. Congratulations. You successfully made money by being a degenerate. I don't know. I don't know what else I can say for you. I'm still not seeing the Facebook numbers though. Oh, Facebook EPS 3.61 beats 3.02. Estimate sales 28.58 billion beats 27.82 estimate. Where's Ford's numbers? Ford's Q2 EPS 13. Wait, what? Oh, 13 cents. Estimated 5 cents, I think. Yeah. Oh, estimated loss, boost year's outlook. At the end. Well, congratulations. Now you're going to be put in timeout because I don't care. I don't know why you think I care. Like I said, good for you. You got lucky and you hit an earnings play. I don't know why you think you're like cool now because you got lucky. I don't know. Like I said, congratulations, bro. You're not gonna make no 1,000% though unless it goes in the money. So I don't know why. I don't know. Good for you. Like, that's funny. Yeah, Facebook's getting clapped. Still waiting on ServiceNow and PayPal. Now's popping. Where is the service now? Is this like a glitch? I'm not seeing ServiceNow or PayPal. Where is ServiceNow and PayPal? ServiceNow's down. Unless my chart's just tripping. There's ServiceNow. ServiceNow reports Q2 1.42 versus 1.2 estimated. Revenue 1.41 versus 1.36 billion. So they did pretty good. Pretty good. Now we're just waiting on PayPal. Yeah, I'm sure it was pricing in a decent amount. I don't know what it was pricing in, but Ford just reported their earnings. That's not news. It's just the earnings report. And they guided for future growth. I think they were expecting to miss on EPS, like have negative EPS, and then they reported positive. So that is good for Ford. But where is PayPal? All right, for sure, Jake. Have a good rest of your day, bro. Where's PayPal? Like, for real. Is PayPal not going to report? Make sure you guys hit that like button. Appreciate everyone here. I think your earnings is pretty much over. I don't know why PayPal isn't coming out. That's the only one we're waiting on now. We could watch Facebook's earnings call. I don't know what it is, but we can look and see if it's not too late. We might be able to run that. $3 p.m. MDT. I don't know what that is. $3 p.m. Yeah, so Facebook's earnings calls in about 45 minutes. We could stick around for that if you guys want. PayPal numbers should be coming, though. Where's those PayPal numbers? Should be coming out. Hello, PayPal. Where are you? PayPal Q2 total payment volume 310.9 billion, estimated 297.08 billion. PayPal reaffirming full year revenue outlook. Where's the EPS and revenue, though? Ah, there it is. PayPal reports Q2 1.15 versus 1.13 estimated. Revenue 6.24 billion versus 6.32 billion. Guides Q3 6.15 to 6.25 billion versus 6.48 billion. So they actually guided lower. That's probably why they dropped, because their earnings were, I mean, there weren't anything crazy. Oh, I guess they missed on revenue too. Never mind. Huh. Well, that's no good. PayPal might get clapped. I guess that is that, though. That's your earnings. Such excitement. But for real, appreciate everyone hanging out here. We'll be running the Facebook earnings call as soon as it comes up. So feel free to stick around. Make sure you hit that like button if you have not. Damn, PayPal's really dropping. Woo. PayPal down like $20. I'm not sure what they were pricing in, but I would doubt it's $20. It's a pretty big drop. Pretty big. All right. That is that. Let me throw up the TD Ameritrade. We can throw up Facebook. Got about 15 minutes, 40 minutes till the Facebook earnings call. It's going to be quite some time. Yeah, I can't even get in the earnings call yet. PayPal's still dropping. Here, I guess we can just throw up the E-Trade. Damn, PayPal's down a lot. Make sure you guys hit that like button. Dude, PayPal is getting hammered. What was that pricing in? I think it was only pricing in like a $10, $15 move. It's already down almost 25. That's pretty wild. Yeah, PayPal earnings have been out for like 10 minutes now or something like that. They missed on revenue, gave lower guidance, but beat on EPS. Barely. Ford still coming up. What the hell? GM got some momentum off Ford. I don't think GM had earnings. Pretty sure they didn't. Ford's kind of popping though. Damn, PayPal's still dropping. 275.5 now. Happened to PayPal, they missed on revenue and gave lower guidance for the next quarter. Facebook out. Yeah, Facebook's been out for a while. Even Apple and Microsoft dropped on great earnings. Yeah, but that's the issue. PayPal's earnings weren't that great. Might pick up some. Just be careful with that. Maybe see how it goes. I mean, PayPal, I don't know. I'm biased. I don't really like PayPal, but I would see where it goes from here after them guiding lower into the next quarter. But we'll be watching Facebook's earnings call here in like 30 minutes when it comes out, if you guys want to stick around for that. Because of PayPal. Yeah, they're almost the same thing. Except Square reported earnings last week, and they reported pretty good earnings. Or, not last week. I thought it was recent, though. I could be wrong. It might have, I don't know when it was. I swear it was recent, though. Oh, never mind. Square doesn't report till August 5th, so never mind. I don't know what stock I was thinking about. Hopefully everyone's having a good day so far. Hopefully you were able to get the plays you wanted, whether they hit or not. $370 today. Nice. Yum China just reported. EPS 0.42, estimated 0.44. Revenue 2.45 billion, estimated 2.45 billion. Comp sales 5%, estimated 11.2. I don't even know, isn't it like Yum C? Yeah, it's down a little bit. 370 today, nice. Taking $1,000 to the horse races this week. Why? Why would you waste $1,000 at the horse races? You crazy, bro. Get that YOLO demon out of here. Made 300 last week at the track. I don't care what you made last week. Why? Why are you gambling on horses? I mean, unless it's just fun. I don't know. I wouldn't be gambling on horses though. You could have just gambled on an earnings play instead. I feel like you'd have a better return. I don't know what happened with PayPal. They just had bad earnings. Bring you along. I don't think I want to go to the horses. That doesn't sound like my thing. I don't think I would have fun. If you have to gamble, buy call options on devastated China stocks. I mean, you should have did that yesterday. A lot of the China stocks already bounced back pretty crazy. So I'd wait to see if they continue lower before that. Good food, good drinks, good looking women. I don't know. I still don't know if I'd have fun. Facebook is killing me. You just gotta not YOLO your money away. I'm assuming you traded a weekly option on there. Just don't do that. If you have shares, I mean, it doesn't really matter. I have shares too. It's not a big deal. Google and Caterpillar coming up. Yeah, Google's over. Caterpillar. Never YOLOing. Well, if all you got is shares, I mean, who cares then? You bought those shares because you thought Facebook was a good long-term company. Who cares what's happening right now? They still reported good earnings. Yeah, Caterpillar could be decent, actually. Caterpillar. Caterpillar. When do they report? Oh, they report Friday. I don't know, those options are kind of whack. I don't like it. I don't know. I don't like YOLOing on earnings anyway, so. Better off just doing a Friday, frickin' cheap Friday play. YOLO Fridays. Caterpillar earnings call Friday. Maybe. Fridays. I don't know. We will see what else reports on Friday. Could probably do the Caterpillar one, though. Caterpillar. Oh. Ugh. You got about 20 minutes till the Facebook earnings call. Or maybe we should do the PayPal one. I don't know. When's the PayPal one? Should we do PayPal or Facebook? They both start at the same time. Hello? Anyone? Facebook. Alright, for sure. I just thought the PayPal one might be better because there was more people coming in here asking about PayPal than Facebook. Bueller? 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 That's funny. I don't know, we could flip a coin on it. I'm gonna just flip a coin. All right, we got the coin. Heads is Facebook. Tails is PayPal. Oh my. Where'd the coin go? Tails. They want PayPal. They want PayPal. The PayPal has spoken. Conspiracy? What are you talking about? Conspiracy. Conspiracy theorist. That's a conspiracy. I don't think that really landed on Tails. No. I mean, I wanted to listen to the Facebook earnings call, but the coin wanted PayPal, so we're doing PayPal now. Secret ExxonMobil gonna crush earnings? How's that a secret? Did you just make this up? That's a conspiracy. All right, you got about 15 more minutes, and then we got these earnings call. No, how do I mute the sound? There we go. They always got some like epic ass music playing on every single earnings call. It's so funny. I'm an oil investor. Isn't that a reason not to trust you? You're just telling me what I want to hear. Tell me what you want, what you really, really want. I'll tell you what I want, what I really, really want. So tell me what you want, what you really, really want. A GME freak. You're a commodity freak. You're a super freak, super freak. She's super freaky. Why PayPal went down? The earnings results were good. No, their earning results weren't good. They missed on revenue, and they guided lower into the next quarter, and they barely beat EPS. So their earnings wasn't that good. Oh my gosh. Bro. Oh my. That was so loud. Dun, 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 dun. We're literally on hold. Uber's dropping. Is there news on Uber? Let's rock out. No. That was loud. I don't know what's going on with Uber. Uber's dropping a decent amount, though. Turn them shits up. You were an employee and their stock dropped? Nah, I've never drove for Uber. They won't have me. Uber don't like me. Bunch of player haters. PayPal popping back up a little bit here. We only employ crackheads. I mean, then they should employ me. No, I'm just kidding. That shouldn't be an issue. Building my double garage. I didn't know you were getting a garage built, bro. That's pretty dope. That's pretty dope. Everyone's leaving before we even get to the earnings call. Why did they all stay here when we were doing nothing? Now that something's actually happening, everyone's leaving. Y'all crazy. Hopefully start concrete this week. Nice. That's dope. If nobody sticks around for the earnings call, it may get it may get shut off in the middle of it. Just a fair warning to anyone who's sticking around for this. But all the people who are sticking around, appreciate you. Holy. The music is always just too crazy. I'm not seeing any news on Uber. Just a bunch of tweets of people complaining about it dropping. Like, I don't know. I don't know what to tell you, bro. You bought it for a reason. Shit, I'd be down to buy some Uber. I don't know why it's dropping, but Uber's pretty... It's approaching a super key level, actually. Ooh, Uber might be a good swing trade tomorrow. We're going to have to look at that. Super key support level on Uber. You're going to shut off on me? I mean, you're actually just going to listen to the whole earnings call? You guys. You guys. Just kidding. I'll probably listen to it too. There will be a market correction. Uber's not high, though. What do you mean? Uber's the opposite of high. Uber's actually low-key kind of clapped. Holy crap, they're still making us wait here. Just trying to watch this earnings call. Come on, mate. We got about 2 more minutes till this earnings call begins. Holy crap, bro. Their music is insane. Should be on in about 30 more seconds, but they're usually late, so we will see. Should be coming up any minute. Coming in hot. But they're still playing music. All right, here it is.
All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, simply press star followed by the number 1 on your telephone keypad. If you would like to withdraw your question, press the pound key. Thank you. I would now like to introduce your host for today's call, Ms. Gabrielle Rabinovich, Vice President, Corporate Finance and Investor Relations. Please go ahead.
Thank you, Buena. Good afternoon, and thank you for joining us. Welcome to PayPal's earnings conference call for the second quarter of 2021. Joining me today on the call are Dan Schulman, our President and CEO, and John Rainey, our Chief Financial Officer and EVP Global Customer Operations. We're providing a slide presentation to accompany our commentary. This conference call is also being webcast, and both the presentation and call are available on our Investor Relations website. In discussing our company's performance, we will refer to some non-GAAP measures. You can find the reconciliation of these non-GAAP measures to the most directly comparable GAAP measures in the presentation accompanying this conference call. Management will make forward-looking statements that are based on our current expectations, forecasts and assumptions, and involve risks and uncertainties. These statements include our guidance for the third quarter and full year 2021. Our actual results may differ materially from these statements. You can find more information about risks, uncertainties, and other factors that could affect our results in our most recent annual report on Form 10-K and quarterly reports on Form 10-Q, filed with the SEC and available on our Investor Relations website. You should not place undue reliance on any forward-looking statements. All information in this presentation is as of today's date, July 28, 2021. We expressly disclaim any obligation to update this information. With that, let me turn the call over to Dan.
Thanks, Gabrielle, and thanks everyone for joining us today. I'm pleased to say that on the heels of a record year, our Q2 results once again reflect some of the best performance in our history on both an absolute and a relative basis. It is now clear that customers around the world have embraced all forms of digital payments, even in regions where in-person activities are returning towards pre-pandemic levels. In this new normal, PayPal serves as an essential and trusted platform for both consumers and merchants across all forms of commerce, payments, and basic financial services. As a result, we hit a new milestone in Q2, surpassing $300 billion of TPV for the first time in our history, growing 40% on a spot basis to $311 billion, with an annualized run rate of approximately $1.25 trillion. This is even more notable given that eBay's TPV on our platform declined by 37%. eBay exited the quarter at under 4% of our volume, and we expect their TPV will approach 2.5% of our total volumes by year end. Excluding eBay, our volumes grew by a remarkable 48% on a spot basis. Our active accounts now exceed 400 million, up 16% to 403 million. We added 11.4 million net new active accounts in the quarter, including an additional 1.5 million merchant accounts. That brings our total merchant count to 32 million. We still expect to end the year at the higher end of our previous guidance of 52 to 55 million net new active accounts. Transactions in the quarter grew by 27% to 4.74 billion. And even as our net new actives continue to show strong growth, our transactions per active account accelerated 11% in the quarter to 43.5 times as our consumers engage more frequently across our growing suite of services. We grew our revenues by 19% to $6.24 billion. This growth comes even as we lapped strong results from last year and absorbed 811 basis points of revenue pressure from eBay, as their revenues on our platform declined 51% in Q2. Excluding eBay, our revenues grew at approximately 32%. We now expect that eBay will be essentially 100% complete with their migration to managed payments by the end of the third quarter. We are maintaining our full year guidance despite the fact that this accelerated ramp puts an additional 100 basis points of revenue pressure in 2021. The good news is that this pressure begins to ease in Q4 and obviously positions us for accelerated revenue growth in 2022. Finally, we delivered non-GAAP EPS of $1.15, even as we continue to invest heavily in our growth initiatives. Venmo continued its strong performance in Q2 with $58 billion in TPV, up 58% year over year, with over 76 million active accounts. Revenue growth accelerated to almost 70% in Q2, our highest growth rate in the past year, fueled by Venmo's product diversification strategy. More than 500,000 customers have established new business profiles on Venmo, with more than 300,000 created in Q2 alone. Pay with Venmo revenues grew by 183% year over year. We're also seeing strong adoption and trading of crypto on Venmo. And this quarter, we expanded the Venmo value proposition to allow merchants and consumers to pay for goods and services and receive buyer and seller protections for commerce transactions. This has been a very successful feature on PayPal's P2P services, and we expect it will be widely adopted on Venmo. I'm pleased to report that the initial version of our new consumer wallet super app is code complete, and we are now beginning to slowly ramp. In the next several months, we plan to be fully ramped in the US with a host of products and services across payments, basic consumer financial services, and commerce and shopping tools launching every quarter. New features will include high-yield savings, early access to direct deposit funds, new and improved bill pay functionality, messaging capabilities outside of P2P to enable family and friend communications, as well as additional crypto capabilities and customized deals and offers. Each wallet will be unique, driven by our advanced AI and machine learning capabilities in order to enhance each customer's experiences and opportunities. As I previously mentioned, 32 million merchants now rely on PayPal. They trust that our scale, security, tools, and resources will help them to grow their businesses in today's rapidly emerging digital economy. PayPal is the only payments company to offer features like global seller protection and fraud prevention services at no additional cost. We are one of a few payments companies to allow consumers to use cryptocurrency as a funding source to check out on our platform. Our Buy Now, Pay Later offering comes at no additional cost to merchants while boosting their conversion rates and increasing cart sizes by 39%. And we continue to expand our product differentiation through recent acquisitions like ChargeHound and Happy Returns that will drive additional value to both consumers and merchants post a sales transaction. Our announced pricing adjustments in the US align our pricing with the value we deliver, while giving us flexibility to aggressively compete in full stack processing and at point of sale checkout. We continue to see strong demand for our in-store services, with approximately 1.3 million merchants now accepting our QR codes and continued momentum and excitement across our large enterprise merchants. In fact, every 20 seconds, a new merchant signs up to use our QR codes. It's also very encouraging to see that consumers who use our QR codes spend more TPV, in fact, 19% more TPV on the PayPal platform. Our in-store efforts will no doubt be a multi-year journey, but these trends reinforce our conviction to be a seamless omni-channel wallet. In Q2, our overall in-store efforts across QR and cards equaled $6.8 billion in TPV, up 39% year over year. Our in-store suite of services continues to expand with the launch of PayPal Zettle in the US. As in Europe, PayPal now offers small businesses in the US an integrated commerce solution that not only helps them to accept payments in store with the Zettle card reader, but also helps them to manage sales and inventory across their various channels, all in one place. Our Buy Now, Pay Later product continues its strong growth and is proving to be extremely popular for consumers and merchants alike. Since launch, we have processed over $3.5 billion in TPV, with more than $1.5 billion of that TPV in Q2 alone. Approximately 650,000 merchants have customers who use our Buy Now, Pay Later capabilities, and 40,000 have positioned Buy Now, Pay Later upstream on their product pages. Over 7 million consumers have transacted more than 20 million times with our Buy Now, Pay Later product. Australia is now fully deployed and off to a strong start, with additional countries in Europe slated to roll out later this year. Our employees, customers, and government officials expect PayPal to be a role model and a responsible corporate citizen. I am proud to say that we are delivering on our commitments to advance social justice and racial equity. Over the past year, we have committed all of the $535 million we pledged towards advancing racial economic equality. And we recently launched a new $100 million commitment focused on women's economic empowerment. These efforts are a direct reflection of our values and our belief that PayPal must be part of a solution that drives a better future for all of us. I'd like to thank our employees for their passion and their never-ending commitment towards shaping a new and inclusive financial services system. We are entering a new era, and we couldn't be more excited to help drive an emerging digital future where all small businesses and consumers can participate and thrive in a post-pandemic world. And with that, let me turn the call over to John.
Thanks, Dan. I'd like to start by thanking the entire PayPal team for their continued commitment to serve our customers and execute on our priorities. We're reporting another very strong quarter. Our results are indicative of the strength, diversification, and breadth of our two-sided global payments platform. PayPal sits at the intersection of digital transformation and e-commerce penetration. As the largest open platform for digital payments globally, we're uniquely positioned to address the opportunity that these secular tailwinds present. Over the past 6 quarters, our team's focus, collaboration, and resilience have allowed us to innovate at scale and deliver our best performance in company history. Globally, the pace and shape of the recovery varies. As the environment continues to evolve, we are evolving with it to serve the changing needs of our consumers and merchants. During the second quarter, restrictions started to relax across our core markets, and we saw the beginning of a return to normalcy in consumer behavior. Consumers are spending again in verticals that had been severely affected and have become more comfortable shopping in person and dining out. Merchants are repositioning for the post-pandemic world. Relative to our expectations, which were for reopening spend to closely track vaccination rates, we've seen travel and events volumes return more rapidly. At the same time, in markets that have reopened, elevated e-commerce spending above pre-pandemic levels is ongoing and indicative of permanent shifts in consumer behavior. On a 2-year basis, our business performance is remarkably consistent and very strong. Our second quarter results last year were exceptional. We grew revenue 22%, delivered a 28.2% operating margin, and grew non-GAAP EPS 49%. Both the operating margin and earnings growth were the best performance we've ever delivered. It's remarkable that in the second quarter this year, when we're lapping this explosive growth, our business is continuing to perform at a very high level. Our results are even more impressive given the transitory headwinds we're facing from eBay. This year, as part of eBay's managed payments transition, we're absorbing a rapid migration of marketplaces volumes off of our platform. Further compounding this effect is that eBay benefited meaningfully from COVID last year, which makes the comparison this year even more difficult. For context, from 2016 to 2019, the 3-year compound annual growth rate for eBay Marketplace's revenue on our platform was approximately 2%. And in 2020, this revenue grew 11%, approximately 5 times faster. Also worth highlighting is that through this period, as eBay's contribution to our revenue declined from 22% to 13%, we've expanded our operating margin 500 basis points. Given the accelerated pace of migration in 2021, there's a more pronounced effect on our operating margin and earnings growth profile this year. At the same time, this is truly a transitory effect on our results, which we now expect to be very largely contained to 2021 with much less of a tail into next year. And as we've discussed over the past several quarters, near-term forecasting continues to be complex given the global macroeconomic backdrop, varied stages of pandemic recovery, and differing paths of reopening. It's with this orientation and mindset that we head into the back half of 2021. Before discussing our outlook for the remainder of the year, I'd like to highlight our second quarter performance. Total payment volume grew 40% at spot and 36% on a currency-neutral basis to $311 billion. Our Q2 TPV grew at a two-year compound annual growth rate of 34%, accelerating from 33% in Q1 and indicative of the strong momentum in our business. Versus the second quarter last year, merchant services volume grew 43% currency neutral. A resurgence in travel and events as well as core payment volumes contributed to this performance. This quarter, eBay had a much greater effect on our TPV than in the first quarter. In Q2, eBay marketplaces volumes declined 41% currency neutral from last year. This is in comparison to a 3% decline last quarter. eBay represented 4% of our volume in Q2, down 512 basis points from last year. In addition to lapping elevated growth during the pandemic, we saw a faster ramp of the payments transition than what we had expected earlier this year, which resulted in a larger decline in Q2 volume. Given the speed at which we're seeing intermediation progress, our plans now contemplate nearly 100% completion of the merchant migration by the end of the third quarter. This accelerated time frame means that while we expect a similar drag to our volume, revenue, and earnings growth in the third quarter, this impact lessens in Q4 and begins to tail off from there. As a result, we will have a much cleaner exit to 2021. Revenue increased 19% on a spot basis and 17% currency neutral to $6.24 billion. Transaction revenue grew 17% to $5.8 billion. And on a two-year basis, transaction revenue grew 22.3% in Q2 versus 22.7% in Q1 of this year. In addition to the consistency of our results, this performance is even more remarkable excluding eBay. In the second quarter, eBay Marketplace's revenue declined 51% in comparison to Q2 20 and 27% sequentially. Our revenue excluding eBay grew 32%, an 11-point acceleration from last year's already strong second quarter. Other value-added services revenue grew 40% on a spot basis and 36% currency neutral to $441 million. These results were driven by strengthening credit performance and portfolio growth, partially offset by lower interest income on customer balances. In the second quarter, transaction take rate was 1.86% and total take rate was 2.01%. The mix effect of eBay contributed to more than a third of the 37 basis point reduction in take rate. The blended take rate on eBay volumes this quarter was 3.22% in comparison to 4.1% in Q2 last year. The remainder of the decline was primarily driven by reduced currency volatility in the quarter, which resulted in a lower growth rate in foreign exchange fees, a decline of $122 million from foreign currency hedges recorded as international transaction revenue, and growth in bill payment volumes. Bill payment is a vertical characterized by both a lower take rate and an overall lower cost of funding than our e-commerce volumes. Q2 was another great quarter of volume-based expense performance. Transaction expense came in at 81 basis points as a rate of TPV this year, relative to 83 basis points last year. Transaction loss as a rate of TPV was a record low 9 basis points versus 12 basis points in Q2 last year. The net effect of credit provisioning on credit losses in the quarter, inclusive of originations and reserve reversals, resulted in a benefit of $104 million. In the quarter, we had an increase in loan origination activity and ended Q2 with $3.9 billion in gross receivables, reflecting sequential growth of 11%. Strong performance of our loan portfolio, improving macroeconomic trends, and the mix of shorter duration originations from our installment pay products resulted in our reserve coverage ratio declining to 14.9% from 21.4% at the end of the first quarter. As a result, transaction margin dollars grew 19% in the second quarter, and transaction margin reached 56.8%. I'd now like to cover our non-transaction related operating expenses. Overall, these expenses increased 27% and represented 30% of revenue. These are higher growth rates than what we've incurred historically, but as I've suggested before, we believe that there has never been a more important time to invest in our business, as the secular tailwinds in our business have perhaps never been stronger. In Q2, we again invested aggressively in product innovation and our go-to-market initiatives. Sales and marketing increased 68% in the quarter, and technology and development spend grew 23%. On a non-GAAP basis, operating income grew 11% to $1.65 billion, and our operating margin was 26.5%. This includes an approximately 12% or $360 million decline in transaction margin dollars from eBay marketplaces. Normalizing for the reserve build last year and subsequent release this year, non-GAAP operating income declined 7% and operating margin was 23.9%. And on a 2-year basis, the compound annual growth rate for operating income is 29%. For the second quarter, non-GAAP EPS grew 8% to $1.15. This includes an approximate 27-cent per share headwind from the decline in eBay Marketplace's transaction margin dollars. Adjusting for our increased credit provisions last year and this year's release of reserves, EPS declined 9%. And on a 2-year basis, this represents 27% earnings growth annually. We ended the quarter with cash equivalents, and investments of $19.4 billion, and in addition, we generated $1.1 billion in free cash flow. I'd now like to discuss our outlook for the rest of 2021. Our business is performing exceedingly well and overall consistent with the outlook we provided on our last call. Given our strong year-to-date performance and our expectations for the back half, we're raising our TPV outlook and reiterating full-year revenue and earnings. We now expect TPV growth to be in the range of 33 to 35%, given the strong volume trends in our business. We continue to expect revenue for the year to be approximately $25.75 billion, representing 20% growth on a spot basis. In addition, we continue to expect non-GAAP earnings per share to be approximately $4.70, or growth of approximately 21%. We raised our 2021 revenue outlook by $250 million, or approximately 1 point of growth when we reported our first quarter results in May. We're now absorbing more pressure from eBay than we had previously expected. Our current outlook contemplates an approximately 7-point negative impact to revenue growth for the year. This corresponds to an approximately 85-cent negative impact to non-GAAP EPS from reduced transaction margin dollars. We're pleased that the strength of our platform and the diversification of our business is allowing us to maintain this elevated outlook. In addition, we expect to generate more than $5 billion in free cash flow or approximately 20 cents of free cash flow for every dollar of revenue. Now turning to guidance for the third quarter. This quarter, we're up against our toughest revenue comparisons versus last year. In Q3 20, we reported 25% revenue growth, our strongest performance for the year. As a result of this dynamic, as well as eBay's managed payments transition, our plans had always assumed that in Q3 we would report our lowest level of quarterly revenue growth for the year. However, we're now planning for eBay's drag on our revenue growth to be greater than previously expected, resulting from both the accelerated pace of merchant migration in international markets, as well as some additional core pressure, which magnifies this result. For the third quarter, we expect revenue to be in the range of $6.15 billion to $6.25 billion. At the midpoint, this represents growth of approximately 14% at spot and includes about 8.5 points drag from eBay, or approximately $465 million negative impact. On a two-year basis, inclusive of this drag, our guidance represents 19% growth. We also expect non-GAAP diluted EPS to be flat to last year, or approximately $1.07, reflecting increased investments to support our growth initiatives and the pressure we're facing from eBay. Our financial performance over the first half of 2021 has been very strong and consistent with the guidance we've outlined at the outset of each quarter. At the same time, the environment in which we're operating, while more stable than a year ago, continues to be very dynamic and more challenging to predict than normal. Adding to the complexity is this exercise of predicting eBay's transition, for which we have less than perfect visibility. Each quarter, we've tried to provide our best estimate of the level of performance that we believe we can deliver. Overall, our growth remains strong, and importantly, we continue to see the categories that benefited from quarantine measures and shelter-in-place activities last year maintain higher levels of e-commerce volumes in comparison to pre-COVID levels. Our conviction and our ability to drive sustainably strong performance and in the strength of our franchise has never been greater. This year, we expect to process approximately $1.25 trillion of payments volume. We expect to grow revenue by 20%, more than offsetting pressure to revenue growth of approximately 7 points from eBay and lapping our strongest year with 22% revenue growth. And given the momentum we have in development and innovation and the pace of scale of the new experiences we're bringing to our customers, we are investing in our business at record levels. Further, last year we grew earnings 31%. On top of that performance, this year we plan to grow our earnings by 21%. Importantly, our team has never been more focused or aligned around the shared goal of being the leading digital payments company in the world. Last year was a pivotal moment in our history, and this year we're building on that foundation and continuing to realize our ambition for greater relevance, ubiquity, and impact as a global payments leader. We look forward to sharing more of our progress with you. With that, I'll turn it over to the operator for questions.
As a reminder, to ask a question, press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Your first question is from Tien-Tsin Huang of JP Morgan. Your line is now open.
Thank you. Thanks so much, and thanks for all the details on the slides here. It's good to go through it. Just with the third quarter guidance being a little bit lighter than trend, but you're also reaffirming the year, even with eBay expected to be 1 point worse. Can you just reconcile that thinking between the third quarter and holding the year? And then also, if you could just help us bridge third quarter to fourth quarter growth for us, given all the moving pieces here, that'd be great. Thanks.
Sure, Tien-Tsin, I'll start there. Look, third quarter has always was going to be our toughest quarter from a year-over-year growth rate perspective for a lot of the reasons I outlined. There are a number of reasons that are contributing to the growth in the fourth quarter, but I think before I get into them, it's important to understand that if you look on a year-over-2-year basis, the revenue growth actually is very consistent in each quarter this year. And for the full year, we'll be growing in the neighborhood of 20%. But of the items that are contributing to the growth in the fourth quarter, there's a few that I think are notable to call out. One is certainly less pressure from eBay. That abates somewhat in the fourth quarter. We also have some benefit from the pricing changes that we announced that go into effect next month. And then we have a number of different initiatives that we're rolling out in the second half of the year in which we get most of the benefit or a full quarter's worth of benefit in the fourth quarter. And so all of those things tend to drive, I think, some acceleration in what we're seeing in revenue from the third quarter to the fourth quarter. And then, as usual, we always have some seasonality around the holiday shopping season, which we, again, expect this year.
Now, if there's one thing I can add to John's comments, is Q3 is the height of eBay pressure. And then, as John mentioned, as we go into Q2, those headwinds that have been blowing against us on eBay turn around and become tailwinds. So we have something like 850 basis points of pressure in Q3, as John mentioned. That drops to 600 basis points of pressure as we go into Q4. So that's a natural lift of about 2.5 points of revenue growth. And as we go into 2022, that continues to help our results. And I think if you look beyond the eBay impact and look at our adjusted results, you can see that the core business and the strength of our franchise has really never been performing better. I think John mentioned one thing that I think is worth highlighting, that the elevated spend around online is continuing even as we see economies reopen. I mean, you can see that in our growth rates of our volumes, up 40%, 48% without eBay. But if you even look at things like our daily active users, our daily active users versus pre-pandemic levels are up 43%. They were up substantially last year, and they continue to grow as we go into this year. And so I think we have a lot of strength in the core. Some of that's being masked by eBay, but eBay is all about timing. We always knew these revenues were moving away. It was just a matter of timing. And now we've got kind of what we think is the right case, 100% in third quarter, and then from there on in, those pressures abate.
Agreed. No, I think it's just better to rip off the Band-Aid.
Absolutely.
Thank you both.
Flush it out of the system.
Thank you
exactly
both.
Right. Yep.
Thanks both. See you. Thanks.
Thanks, Injun.
Your next question is from Ashwin Shirvaikar of Citi. Your line is now open.
Thank you. Hi, Dan. Hi, John. I know you both provided a lot of information on eBay throughout your prepared remarks, but I did want to drill down further into sort of the overall effect of eBay on your results. If you can kind of speak to the ongoing impact through the back half of the year and into next year. And then the flip side, obviously, you mentioned the ex-eBay performance, the 32% growth and so on. Should one expect that to be, coming out of this, that sort of growth rate to be sort of a more normal appearance of what you can do?
Sure, I'll start, Ashwin. I'm sure Dan will want to jump in. Look, I think there's a couple metrics that really highlight the true performance of our business. But to start with, we've always known that 2021 was going to be the year where we had the most significant impact from eBay. And the fact that we're lapping what was tremendous growth last year and still performing at the level that we are this year in the face of that impact from eBay is really just quite phenomenal. But I'll give you an example that I think really tells the picture here. So last year in the second quarter, we grew revenue 22%. And in that number, there was a benefit of 5 percentage points of growth from eBay. So 22% revenue growth with 5 percentage points of benefit from eBay. This year in the second quarter, we grew revenue 19%. And that number included 8 percentage points of headwind related to eBay's business. And so that really underscores the strength of the franchise and how well we're performing right now. And quite frankly, it's something that we're very excited about because this sets us up for, I think, much cleaner performance going forward and an acceleration in some of our growth rates when eBay is a much slower growing and smaller part of our business going forward.
Yeah, if I can maybe complement some of John's comments there. First of all, I do want to say this about eBay. Obviously, they remain a very close strategic partner for us. We still have about 60% share of checkout on eBay, and obviously eBay merchants and consumers want and desire to use PayPal. If you think about, just to give perspective, historic perspective, if you think about when we split from eBay 6 years ago, eBay's revenues as a percent of our total were 26% of our total revenues. And we believe that they're going to end this year around 3% or so, and that their TPV is going to be under 3% as a percent of our overall volumes. And so this is, as I mentioned before, it's a timing issue. And frankly, the sooner eBay transitions, the better it is for our future revenue growth. I'd also say just one other thing. We are making a lot of progress with a lot of other marketplaces coming out of the eBay restrictions, and we continue to see Alibaba continue to ramp. We're really pleased to watch the growth rates there. And we're making a lot of progress with a lot of other marketplaces that we'll talk about as we get along further in the year. So this eBay transition is behind us at the end of this quarter. The headwinds dissipate, and we're glad to start to move forward. And as John said, you'll really be able to see the strength of the franchise start to shine as a result of that.
Thank you. Thank you for those comments.
Yeah, you bet.
Your next question is from James Fawcett of Morgan Stanley. Your line is now open.
Good afternoon, and thanks for all the commentary, Dan and John. I'm sure there'll be additional questions on the quarterly cadences and eBay, but I wanted to touch on, or for you to touch on something you mentioned earlier, and that is growing in-store acceptance and QR codes. We've heard some positive things from industry sources recently on growing usage there, and I'm wondering if you can give a little color on what you're seeing from PayPal's perspective and how your acceptance works with the partnership with Clover from Fiserv and what is done to enable that for merchants and consumers.
Yeah. I think I'll start on this one, and then maybe John can kick in. So first of all, clearly, pretty much every merchant, whether it's small, mid-sized, or large, is envisioning a seamless omni-channel feature. And that's where physical and online kind of blur together, that they now start to use that to digitally interact with their customers to basically tie in their loyalty programs, customize deals and offers to individual consumers, and that is moving well beyond just checkout. Before we were thinking QR codes and other forms of contactless payments were great because, it was both fast and maybe more healthy in a pandemic environment. But all of our conversations now go beyond checkout. People are looking to drive loyalty. They're looking to drive rewards and coupons, more flexibility in how consumers order, track, pay for their services, customize incentives. And so that's really the conversations that we're having, and that's why we're getting a ton of traction. By the way, I do think that this seamless omnichannel efforts by us is key to us doing everyday usage. And if I look at not just, multiple millions of consumers that are using, our QR codes, but what's happening is they also are spending 19% more TPV on the PayPal platform. And that halo effect is a big deal as we look forward, especially as we look towards the super app, which maybe somebody will talk about later. But the more and more of these services we put together, the more and more of that halo impact that occurs. And so, we obviously are up to now 1.3 million merchants. Every 22nd, a merchant signing up for more QR codes with us. We have a lot of momentum with large enterprises right now. But the conversations have moved to how do we fully integrate their loyalty programs into our app? How do we drive customized deals for them? And so those are taking a little longer to go live to site, but they're much more integrated than we've ever seen before. And we're seeing with customers like CVS, once you start to integrate that together, once you start to get a habituation, we saw CVS transactions go up 151% month over month. And so we're really beginning to see some traction in the marketplace around all of these things. Very excited about it. It's going to be a multi-year journey for us, but we know that both merchants and customers expect us to be fully omni.
Thanks a lot.
Yeah, you bet, James. Oh, yeah. By the way, James, one other thing. You talked about Fiserv Clover. I forgot about that. So, that is rolling out this quarter. We are a default funding instrument on Clover. It's a very close partnership that we have with Fiserv, and we're looking forward to reporting more on that as quarters go on.
Thanks for catching that, Dan.
Yeah. Sorry about that. Yeah.
Your next question is from Darrin Peller of Wolfe Research. Your line is open.
All right. Hey, thanks, guys. Look, it's great to hear that the super app refresh is going well. If you could just give us a little more specifics on the timing of the rollout, and then what you're looking for it to mean in terms of engagement or impact on NNA levels. And I guess just quickly on NNAs, Dan, you mentioned earlier you're still confident in the high end of the 52 to 55 million range, which would require a bit of a step up from second quarter levels. So just any more color on the conviction there. Thanks, guys.
Yeah, sure. I'll start right with that quickly. We always knew that second quarter was going to be the low point of the year because we did 0.3 or 0.4 million NNAs a year ago. And even though they're performing better than cohorts that we previously had historically, their churn is lower. It's still a ton of incremental churn versus traditional cohorts on the second quarter. We're clearly beginning to see that dissipate already this year as I look at NNAs coming in. And so, I feel really good about that guidance right now. Q4 is always our high point of the year. And so you'll see it start to build from second quarter up into third quarter and then up again into fourth quarter. Then maybe if I can just, if that answers your question on NNA, I'll go quickly into the super app. We made a really substantial milestone by being code complete on this first iteration of the super app. we're slowly ramping. This is the first change we've done to the app. First change since I've been here that we've done to the app. And so we want to kind of measure what the engagement levels are and the uptake of it. But this is going to be something where, this isn't a big bang theory that, this app in and of itself, this version is the be all and end all. It obviously is going to look across payments, basic financial services, and shopping tools. You're going to see releases and enhanced functionality come out pretty much every single quarter. But early on, that's going to include things like high yield savings, enhanced bill pay, which will do improved search and a better UX, more billers, aggregators. We're going to do 2-day early access to direct deposit, budgeting tools. Something we haven't talked about, two-way messaging. So if I P2P you, $10 for whatever you're doing, and you want to message me right back without sending me a P2P, you can go do that. And we think that's going to drive a lot of engagement on the platform. You don't have to leave the platform to message back and forth. Obviously, the UX is being redesigned. We've got rewards and shopping. We've got a whole giving hub around crowdsourcing, giving to charities. And then obviously buy now, pay later will be fully integrated into it. And by the way, as we go into next year, we got the last time I counted, it was like 25 new capabilities that we were going to put into the super app. And so, I don't want to dismiss at all what we've done right now, but it just continues to improve going forward. And the way that I'm looking at success with the super app is what kind of engagement levels do we get? I fully expect engagement to move up. What's happening to our average revenue per active account? And by the way, even with the new services we've recently launched, our average revenue per active account ex eBay went up 13% this past quarter. And that's a really good sign, along with the 11% improvement in TPA, which was really a record in the last 4 years or so. And so we've got a lot going on. I think engagement, average revenue per active user, and then we'll look clearly at all the halo effect as well. But we're excited to be on the journey right now and be underway. And again, you just see it continue to improve quarter over quarter.
That's great to hear. Thanks, Dan.
Yeah, you bet.
Your next question is from Colin Sebastian of Baird. Your line is now open.
Great. Thanks. Good afternoon. Wanted to follow up on the Pay Later initiatives. Those clearly are gaining nice traction with users. I wonder how much of that activity is incremental to volume, if that's just a function of the higher conversion rate, and secondarily, we've heard from some merchants that return rates are a little bit higher with Pay Later. So I'm just curious if that impacts merchant adoption at all. Thank you.
Yep, sure. So look, it was another terrific quarter. I mean, it just in every way for buy now, pay later. As I mentioned, we did 1.5 billion of TPV in the quarter alone. That's out of 3.5 billion. But this is the amazing piece of stat on that 1.5 billion. That's up 50% from Q1 sequentially. So you can really see that even if we had so much momentum, in Q1, that momentum really accelerated in Q2. We've got a bunch more merchants using it now, 650,000 merchants. More and more of them are presenting it upstream on their product pages. That obviously gives us a disproportionate share of checkout when that occurs. And, you could tell by the 7 million customers doing 20 million plus transactions that obviously our repeat rates are extremely high. There's a lot of satisfaction with the product. It's still something like 70% are repeating within 6 months. And our halo effect is the same as it was last quarter. Still a 15% halo effect in TPV, still a substantial reduction in our TE costs, about a 16% reduction. We're still seeing 80% plus of these funded through debit. Australia we put into place just a couple of weeks ago, and bam, it's off to a really strong start right away. So, and part of the reason that we're getting such strong results is because we have 400 million customers, and when we put something in, it happens at scale, and we know those customers, so the approval rates are much higher, returns are lower, because we know the customer. And so a lot of the other buy now, pay later players don't necessarily know the consumer the way that we know the consumer in this. And so we're pretty pleased. We've got a ton on our roadmap ahead in terms of expanding internationally, the more and more functionality that we want to put on the product itself.
Colin, I'd just add a couple points there I think are really encouraging as we look at the early progress there. One is that where we have upstream presentment, we see a double-digit click-through rate from consumers, which is quite encouraging, and particularly when you think about what Dan mentioned and scaling that across all of our customer base. But the other, and it's a very important one, and it actually ties back into Darren's previous question around revenue per user and engagement, but we see a 15% lift in overall TPV among those customers that are using buy now, pay later. So, we're early stages here, but as we've repeatedly said, we think that we've got a value proposition that is frankly second to none, and quite encouraged by some of the early results that we're seeing.
Great. Thanks, guys.
Yep.
Your next question is from David Togut at Evercore ISI. Your line is now open.
Thanks so much, Dan and John. Given the new PayPal pricing model on branded and unbranded products effective August 2nd, can you gauge for us the expected annualized impact on revenue and non-GAAP EPS from these changes? And then as part of that, could you just elaborate on your physical point-of-sale payment strategy, given the size of the price cut on physical credit and debit card transactions is quite substantial?
Sure, I'll take the first part of that question, David. Look, our pricing change included both price increases and price decreases. And, it remains to be seen sort of the volume changes that come from each of those. And so in the context of our $25+ billion revenue base, I would say that for the year, these are relatively immaterial on our results. But I think very importantly, this provides a lot more transparency and clarity to our customer base around how we're pricing and really trying to price to the value that we provide for these customers. And we've demonstrated time and again where that value comes from, and just survey data on customers' willingness to buy when PayPal is presented at checkout that is exponentially greater than when it's not. So this is probably overdue. It's been the first time in 20 years that we've made a change to our base pricing like this, but certainly think it puts us more in line with the market and really prices to the value that we're creating for our customer base.
Yeah, I think that is a pretty comprehensive response from John. I mean, we obviously carefully review every one of our pricing changes, up or down. We do extensive market research before we do any change. And as John said, we look at where we add value and we price in accordance with that. Clearly on the branded side, we think we add a tremendous amount of value. Things that John talked about, buyer and seller protection, buy now, pay later at no incremental cost, fraud protection, highest checkout conversion, et cetera. But we took down rates for basic full stack processing. That also was reduced somewhat substantially from the 2.9 plus 30 to 2.59 plus 49 cents. And that is going to enable us to aggressively compete for all of the payment processing of the merchants that do business with us. And, you've heard us say time and time again, David, that we are going to move into the in-store space, and we are going to move so aggressively in there. We rolled out Zettle in the U.S. It is a really beautiful full package. It doesn't just include card reader, but inventory management, sales reads out, and allows a merchant to seamlessly load inventory in both their online and in-store locations, and then across multiple channels as well. And so we're obviously going to be very aggressive on moving into in-store. It's always been part of our strategy. And by the way, if a small merchant does all of their business with us, they could actually see their overall costs come down. And we want to encourage them to do all of their business with us because we are a trusted platform. They do turn to us. And, we price, we think, the right way. We finally have unbundled some of this branded and unbranded because that's how the market is playing, and we know where we want to be aggressive, and we're going after that.
Thanks so much, Dan and John.
Yep, you bet, David. Thank you.
Your next question is from Ramsey El-Assal of Barclays. Your line is now open.
Hi, Dan and John. Thanks for taking my question this evening. Dan, I wanted to get your updated view on crypto and blockchain and see how you guys are planning on engaging with the ecosystem from a consumer product perspective. And I know you just mentioned some new crypto capabilities in the new app, but also from like a balance sheet perspective and internal technology perspective, how will you kind of engage with the ecosystem in the quarters ahead?
Yeah. Well, we continue to be really pleased with the momentum we're seeing on crypto, and we're obviously, adding incremental functionality into that. Whether you probably saw we increased limits to 100,000 a week. We're right in the middle of some open banking integration, which will increase the ability to fully integrate into the ACH and do faster payments. We're going to launch, hopefully maybe even next month, in the UK, open up trading there. We're working right now on transfers to third-party wallets, and we really want to make sure that we create a very seamless process for taxes and tax reporting. And so we're really looking at how do we integrate that into both the trading and the buy with crypto on our platform. But I will say this, all of that is interesting, but it isn't the main course in terms of what we are trying to do with our blockchain and digital currency business unit. We are clearly thinking about what the next generation of the financial system looks like, how we can help shape that. We are working with regulatory agencies, central banks across the world. The number of countries that are looking at CBDCs, central bank issued digital currencies, is increasing rapidly. You're at 40 countries 6 months, a year ago. You're almost up to 100 countries looking at it right now. And clearly there is an opportunity to think about a new infrastructure that can more efficiently, read that to be a lower cost, do transactions, and also get money to people much faster than happens today. The other day I sent an EFT from one bank to another bank, and that bank told me it would take me 3 days to access that money on the EFT I sent. That's crazy. It needs to be instantaneous. And there's a lot of desire by governments to really think, how can you create a more efficient system using new technology to bring in more citizens, more underbanked, underserved citizens into the financial system, because they disproportionately pay a higher take rate than those who are fully banked or higher income levels. And, there's a lot of connections between digital wallets and central bank issued digital currencies. Imagine not having to send out stimulus checks, but sending those directly into a digital wallet where you instantaneously receive it and you don't have to go and to a check cashing location and exchange that and get charged for that exchange. There's just so many benefits to that, as well as just plain utility to payments. How can we use smart contracts more efficiently? How can we digitize assets and open those up to consumers that may not have had access to that before? And there's some interesting DeFi applications as well. And so we are working really hard. And by the way, as you probably have seen, we are trying to pick off the very best talent in the ecosystem to come work here at PayPal. We have a list of names and phone numbers, and we are slowly but surely building a team that I think is going to really shape the thought process around this, and I'm really pleased with at least the early returns on that. Hopefully that helps you.
It does, Dan. Very interesting. Thanks so much.
Yeah, you bet.
And we have time for one last question from Jason Kupferberg of Bank of America. Your line is now open.
Hey, thanks, guys. Just wanted to ask a couple here on margin. And for starters, can you just reconcile for us the unchanged revenue and EPS guidance for the year with the lowered operating margin guidance, and talk about how much of the guidance change on margin is from eBay versus perhaps elevated OpEx growth expectations? And then just as a quick follow-on, give us a sense of how we should think about the margin potential of your business beyond this year as the eBay conversion moves into the rearview mirror. Thanks.
Sure, Jason, I'll take this, and it's great to speak with you. So, starting with the first part on the change this year, really two things to note. One that we talked about is eBay. eBay, we expect to have an 85-cent impact to our EPS this year. And the fact that we are performing and expect to perform for the back half of the year at this level and being able to weather that impact is I think, really speaks to the strength of the overall business. But the second area, and this sort of gets into the second part of your question as well, but we're also investing aggressively in our business. I would argue that there's never been a more important time in our business to invest right now, to invest for a future where we believe in the primacy of digital wallets. We believe in the permanent pull forward of e-commerce. We believe in the ubiquity of digital payments, and we want to help shape that outcome. We want to be a leader in that space. Now, it happens that the structural nature of our business, our margins want to go up, and by the way, they will, to be very clear about that. But at the same time, we don't want to be a prisoner to expanding operating margin one quarter to the next, because we want to be able to appropriately invest in our business to create the most shareholder value that we can over the long term and become the company that we all believe that we can be. And so, close out, our margins will go up. We said this year that we expect to have flat to maybe some marginal improvement in our margins. But as we noted at our investor day earlier this year, our margins will go up over time. But we want to invest for growth and invest to be that leading digital company, payments company that we know we can be.
Okay. Thanks for the comments.
All right. Thanks, Jason.
I would now like to turn the call back to Dan Schulman for closing remarks.
Thanks so much. Well, thanks everybody for those great questions. And I want to thank everybody for your time. We hope that all of you and your families are staying healthy. And I hope that you're having a great summer as well. And we look forward to speaking to you soon. Take care, and thanks again for your time.
This concludes today's conference call. You may now disconnect.
What excitement, mate. All right. Well, that wasn't that great, but decent earnings call. Yeah. I'm going to get out of here, though. Appreciate anyone who stuck around for the earnings call. I will catch you guys tomorrow for another beautiful stock market stream. So God bless you. Have a blessed day. Peace out.